Oh, chat. Oh, chat. We're back for part 2. We're back for part 2. Hopefully we can finish it today. Oh yeah, there was something in here that I've never seen. Where was it? Here? No. I mean, this is the thing that talks about the 5 million shares preferred. Maybe I'll get to reading this. Maybe, I don't know. This. Oh yeah, this. This is like a list of all of GameStop's subsidiaries. So this will definitely be something to keep an eye on, I would say. They own a lot of things. You got like GameStop Mobile. A lot of interesting things. They don't really say exactly what they are. Wholly owned subsidiary of GameStop, so it doesn't say like what they are. I mean, you could probably look all these up and find out. Like, what's this? GS Mobile Inc. You could look this up. Probably. And doesn't really say anything about it. Doesn't really say anything about it, but I'm sure you could dig in and find more info there. Let's see, part 2, where are we at? Right here. I think it's funny that part 1, I made a separate video for it, and it only got like 80 views or something like that. So it just goes to show that this whole community is just a bunch of fake investors and wannabe traders. Like, if you're a real investor, you'd be interested in learning about all that information. So, I don't know. Pretty funny. Pretty funny. One of the most important videos I posted got the least amount of views. Pretty interesting how that works. It's almost like there's not as many investors as... KCR, what's up, bro? Doing good. Have a girl that things going very good with. I even call her my girlfriend. Still holding GME. Let's go, bro. Let's go. That's hype. I'm happy for you, bro. That's awesome. That's awesome. I love that. Is this where I left off? Pretty sure. I think I left off on part 2. I don't think I read any of it, did I? Oh, I deleted all the clips. Whatever, I'm pretty sure I left off on part 2. What's up, Isaiah? Hopefully we can get through this today. I do not feel that good. I was on the stair climber, like, dying. Like, my head was just pounding. I'm just climbing stairs. Sitting in the sauna, straight dying. But hopefully we can get through this today. It's already pretty late in the day, though. I'm just gonna start. Obviously, nobody's gonna pull up. Bunch of bots in my stream yesterday. Alright. I guess I only started like 5 minutes ago, but I do have to drop out driving my Bible group. Awesome, bro. Well, enjoy it. That sounds great. It sounds like there's a lot of good changes going on in your life, so enjoy it, bro. Enjoy it. Don't be wasting time on this stream, bro. Although, you know, I want you here, of course. Go enjoy your life, bro. Go enjoy it. Alright. Part 2. Market for registrants' common equity, related stockholder matters, and issuer purchases of equity securities. Our Class A common stock is traded under the New York Stock Exchange under the symbol GME. As of March 18th, 2026, there were 448.4 million shares of our Class A common stock outstanding, of which approximately 382.4 million shares, 85%, were held by Seed & Co. on behalf of the Depository Trust and Clearing Corporation, and approximately 66.2 million shares, 15%, were held by our registered holders with our transfer agent, Computershare Limited. Of the shares held by registered holders, approximately 3.3 million were held in our Direct Stock Purchase Plan, DSPP, including 0.2 million shares held in nominee form by Computershare at DTC, with the remainder held directly in registered form with Computershare. As of March 18th, 2026, there were 177,522 record holders of our Class A common stock. Wow. All right, there's a lot more stockholders than I thought. Holy, 177,000, that's a lot. That's a lot. I mean, what is that? If you do 448 million divided by 177,522, that's about 2,500 shares per person, basically. I mean, obviously, that varies widely. Some people have like a couple, some people have multiple thousands. But, yeah, it's still pretty interesting. On June 3rd, 2019, our board of directors elected to eliminate our quarterly dividend in an effort to strengthen our balance sheet and provide increased financial flexibility. During the past 6 fiscal years, we have not declared and do not anticipate declaring in the near term cash dividends on our shares of our Class A common stock. Ah, great. You gotta love that. I think dividends are terrible. Just lowers the stock price, so it's dividends are kind of pointless in reality. In 2025, we issued a special dividend to holders of our Class A common stock in the form of a warrant. The warrants are a little different than a cash dividend. For information regarding the warrant dividend, see Warrant section in Item 7. Management's discussion and analysis of financial condition and result of operations. We currently use and will continue to use all available funds and any future earnings for working capital and general corporate purposes, maintaining a strong balance sheet, potential control transactions, and transformational acquisitions and capital expenditures. Any determination to pay dividends in the future will be at discretion of the board of directors and will depend upon results of operations, financial condition, contractual restrictions, including those under the agreements governing our existing indebtedness, and other factors our board of directors deem relevant. Stock comparative performance graph. The following graph compares the cumulative total stockholder return on our Class A common stock for the period commencing February 1st, 2021 through January 31st, 2026, with the cumulative total return on the Standard & Poor's 500 stock index and the Dow Jones Retailers, Other Specialty Industry Group Index, the quote Dow Jones Specialty Retailers Index, over the same period. Total return values were calculated based on cumulative total return, assuming the investment of $100 in our Class A common stock, the S&P 500 and the Dow Jones Specialty Retailers Index on February 1st, 2021, and reinvestment of dividends. The following stock performance graph and related information shall not be deemed, quote, soliciting material or, quote, filed with the SEC, nor should such information be incorporated by reference into any future filings under the Securities Act or the Exchange Act, except to the extent that we specifically incorporate it by reference in such filing. And this chart is very interesting because, I mean, if this is accurate, GameStop is lagging very far behind the Dow Jones Retailers and the S&P. If GameStop was at the same value as these, you'd be trading at over $150 stock price, which is, what is that, like a 7x from here? So, you know, whether this is accurate or not, I mean, maybe, because back in 2021, you were trading 1-to-1 with these, and now the gap is really wide. So are you going to get another squeeze on GameStop? I mean, we'll see. We'll see. Obviously, that's not something I think about, but still interesting. It's if you put $100 in the stock, you'd be down on your investment like 70%, but you would be up on your investment 100% in the S&P and like 60% in the Dow. So that's pretty interesting, but also they're probably factoring in when GameStop was trading really high, so I don't know. Pretty interesting though. Pretty interesting chart. As noted above under the heading Risk Factors, risk related to our Class A common stock, the market price of our Class A common stock has been extremely volatile due to circumstances outside of our control, including a short squeeze in 2021 that led to volatile price movements that were unrelated or disproportionate to our operating performance. What's up, Ruben? Issuer purchases of equity securities. On March 4th, 2019, our board of directors approved a share repurchase authorization allowing us to repurchase up to $300 million of our Class A common stock. The authorization has no expiration date. We did not repurchase shares during fiscal 25 or fiscal 24. As of January 31st, 2026, we have $101.3 million remaining under the repurchase authorization. Refer to item 7, management discussion and analysis, quote, share repurchases for additional information. Oh yeah, if we don't end up, we should get there, but that should be an interesting thing to read. Management discussion and analysis of financial condition and results of operation. The following discussion should be read in conjunction with the information contained on our consolidated financial statements, including the notes thereto, statements regarding future economic performance, management plans and objectives, and any statements concerning assumption related to the foregoing contained in management's discussion and analysis of financial condition and results of operation constitute forward-looking statements. Certain factors which may cause actual results to vary materially from these forward-looking statements. Accompanying such statements or appear elsewhere in this Form 10-K, including the disclosure under Part 1, Item 1A, Risk Factors. In management's discussion and analysis of financial conditions and results of operations, we provide a detailed analysis for fiscal 25 compared to fiscal 24. For comparison of our results of operations for fiscal 24 compared to fiscal 23, see Part 2, Item 7, Management's discussion and analysis of financial condition and results of operations of our annual report on Form 10-K for fiscal year ended February 1st, 2025, as filed with the SEC on March 25th, 2025. Overview. GameStop Corp., a Delaware corporation established in 1996, is a leading specialty retailer offering games, collectibles, and entertainment products. As we navigate the evolving commercial landscape, our business model is expanding beyond traditional retail to include value creation through disciplined capital allocation. We view our significant cash and liquidity position as a strategic asset to be deployed into acquisitions and control transactions that offer long-term value. In 2025, we drove our strategy, as described in Item 1, through the following initiatives. Growth of collectibles. In 2025, we continued to expand our collectible business, increasing its contribution from 19% of total sales in 24 to 29% of total sales in 25. This growth was driven in part by the rollout of our graded trading card submission services to all U.S. stores, expanded store space dedicated to collectibles, the continued development of our first-party repack offerings, and other strategic initiatives. Wow, almost 10% just from the trading card submissions. Well, of course, all this stuff, but still, like trading card submissions could be like 5-6% of added sales. That's pretty impressive. Capital allocation. In 2025, the company opportunistically raised approximately $4.2 billion through the issuance of interest-free convertible notes and generated more than $319 million in interest income through its disciplined treasury management activities. Profit optimization, indirect spend. We have focused on eliminating non-income generating expenditures. In 2025, we significantly reduced indirect costs and intend to continue this discipline into 2026. International streamlining. We continue to evaluate our international operations for strategic relevance. In 2025, we divested our operations in Canada and shut down our operations in New Zealand. Store fleet optimization. Each year, we conduct a comprehensive review of our store portfolio to identify underperforming locations for closure-based market conditions, operational performance, and other relevant factors. This review resulted in the closure of 727 stores in the United States during fiscal 25. At this time, we do not anticipate closing a significant number of stores in fiscal 26, as our domestic store footprint remains a core component of our logistics infrastructure strategy. New initiatives. In 2025, the company launched Power Packs. Nice. I think is this the first mention of Power Packs in a report? I'm not 100. I think it is. I think this is the first mention of it. In 2025, the company launched Power Packs, a new digital trading platform in partnership with Collectors Holdings, Inc., through its Professional Sports Authenticator division, PSA. Early beta results have been promising. Power Packs is an online e-commerce experience through which collectors purchase graded PSA trading cards that are securely stored in the PSA vault. Cards can be instantly sold back, traded, shipped to the collector, or held for future offers. Yeah, I don't think they've mentioned that at all. I just can't remember, but I'm pretty sure that's the first time they've mentioned Power Packs in a report. What's up, Matt? How you doing, bro? Store count information. So, in 2025, you had 2,325 stores in the U.S. You got rid of 727, which is pretty accurate with this closing list that we found. If you go to 2025, in February, they closed 242 stores. January, they closed 400, so pretty close. I guess you're missing like 100 stores. Yeah, so you're missing like 100 stores off this list, but relatively accurate for just some random list that we found. Canada, you got rid of all the stores. Australia, in 2025, you had 374 stores. They closed 75, and they actually opened one store. Pretty interesting. So you're sitting at 300 stores in Australia, and Europe, they only closed 3 stores. So maybe they're not gonna exit Europe. I don't know. Maybe we'll see. I guess, but it doesn't look like they're making any moves to exit Europe, which is kind of weird because Europe is not doing well. It's the worst performing thing. I think it was performing worse than Canada, so I don't really get why they got rid of Canada and not Europe. Maybe there's something cooking there. But 2,206 stores in total. Consolidated results of operations. So this is their balance sheet. So net sales, 3.6 billion, which is down from 2024, 3.8 billion. Cost of sales were 2.4 billion, and fiscal 24 is 2.7. I don't know if I want to go through all these numbers. You guys can go through that on your own. It's not that hard. Hardware and accessories was 50% of net sales, so still a huge part of the business. I just don't want to go through all the numbers here I think it'll take too long. There's just a lot here. Although gross profit was 1.2 billion basically, SG&A 910. So your operating income on the stores is 232 million for the year, which is huge because in 2024 you actually lost 26 million from stores. So they're actually crushing on the GameStop the business now, the retail stores. So pretty interesting. A lot of interest income as well. You had 271 million in interest income, whereas 2024 you only had 163 million. So they're about to crush 2026, bro. 2026 could be over a billion in income total with cash and the business, of course. And then total net income 418 million. but I believe they're factoring in their loss on digital assets here, so they actually made more technically if you're not factoring in the loss on digital assets. Okay, so yeah, software is 20% of the business, collectibles 30%. So 2.6 billion total sales in the United States, only 38 million in Canada because they closed it. 494 million in sales in Australia, and 429 million sales in Europe, which is down quite a bit from 2024. You had 638 million sales in Europe in 2024. So I don't know what's going on there. Maybe they closed more stores than 3. I'm not really sure on that. Pretty weird. Kind of weird. But yeah, so during fiscal 2025, total net sales decreased 193.1 million or 5.1% compared to the prior year. Net sales increased 22.2% in Australia and 3.6% in the United States, while net sales declined 81.3% in Canada and 32.7% in Europe. The overall decrease in consolidated net sales was primarily driven by 276.1 million or 27.5% decline in software sales, and a 259.3 million or 12.3% decline in hardware and accessories, partially offset by a 342.3 million or 47.7% increase in collectible sales. The decline in the Canada segment reflects the divestiture of that business in the second quarter of fiscal 2025, while the decline in Europe segment was primarily due to the divestiture of Italy and the closure of our operations in Germany, both completed during the second half of fiscal 2024. Okay, I see. So maybe they are going to get out of Europe? I don't know. Pretty interesting. Gross profit increased 82.2 million or 7.4% in fiscal 2025 compared to the prior year, and gross profit as a percentage of net sales increased to 33% from 29.1% in the prior year. Wow, that's impressive. The increase in both gross profit and gross margin was primarily driven by a shift in sales mix towards higher margin product categories, particularly collectibles. Sales of collectibles increased to 29.2% of the total net sales in fiscal 25, compared to 18.8% in the prior year. Selling, general, and administrative expenses. SG&A expenses decreased 220.2 million or 19.5% in fiscal 2025 compared to the prior year. SG&A as a percentage of net sales decreased to 25.1% in fiscal 2025 from 29.6% in the prior year. The reduction in SG&A was driven by a 96.4 million decrease in labor-related costs, consulting services, and marketing expenses as part of our ongoing cost optimization initiatives. In addition, store-related rent and occupancy costs and depreciation expense decreased 94.7 million and 19.2 million, respectively, primarily due to store closures and international divestiture completed in recent periods. Asset impairments. Asset impairment expense was 53.8 million in fiscal 25, compared to 9.7 million in the prior fiscal year. As a percentage of net sales, impairment expense increased to 1.5% in fiscal 2025 from 0.3% in the prior year. The increase was primarily attributable to wealth management's plan, approved in the first quarter of fiscal 25, to divest the company's operations in Canada and France, resulting in the reclassification of the related assets and liabilities as held for sale. We recorded 18.3 million of impairment expense related to the Canadian disposal group in the first quarter, and the divestiture was completed during the second quarter of fiscal 2025. Impairment expense of 29.8 million was recorded on the French disposal group during fiscal 2025, reflecting remeasurements of carrying value relative to fair value. In the prior year, impairment charges primarily related to management's plan, approved during the third quarter of fiscal 24, to divest the company's operations in Italy. See Item 8 Notes to consolidated financial statements, Note 5, segment information, for additional information related to the impact of impairment charges by segment. Interest income net. Interest income net increased $108.1 million to $271.5 million in fiscal 2025, compared to $163.4 million in the prior year. The increase was primarily driven by higher cash, cash equivalent, and marketable securities balances resulting from the issuance of the convertible 2030 notes and convertible 2032 notes, partially offset by $42.2 million of non-cash interest expense related to the issuance of warrants to the holder of the convertible notes. Loss on digital assets and related receivables. Loss on digital assets and related receivables increased to $131.6 million in fiscal 25, compared to no such loss in the prior year. This represented 3.6% of net sales in fiscal 25. The loss reflects a $71.8 million realized loss recognized upon derecognition of our digital assets, Bitcoin, pledged as collateral in our covered call sale strategy. A $59.7 million unrealized loss on the resulting digital asset receivable, and a $0.1 million remeasurement loss on our remaining digital asset Bitcoin holdings. Interesting. Income tax expense net. Income tax expense net decreased $40.3 million to a tax benefit of $34.4 million in fiscal 25, compared to tax expense of $5.9 million in the prior year. The company reported an effective tax rate of 9% in fiscal 25, compared to 4.3% in the prior year. Is that negative 9%? Because it is in parentheses, so it might be negative. The change in income tax expense and the effective tax rate was primarily driven by the $141.1 million release of valuation allowance on certain U.S. deferred tax assets. See Item A, Notes to the Consolidated Financial Statements, Note 15, quote, Income Taxes for additional info. Cash and cash equivalents and marketable securities. So they're sitting on $6.3 billion cash, $2.7 billion marketable securities, so a little over $9 billion total in cash and marketable securities. So absolutely crushing. What's the income on that? 9 billion times, it's around 3.5%, so 315 million in interest income. Pretty solid. Sources of liquidity, uses of capital. Our principal sources of liquidity are cash on hand and cash from operations. As of January 31st, 2026, we had $6.3 billion of unrestricted cash and cash equivalents and $2.7 billion of marketable securities. Our cash and cash equivalents are carried at fair value and consist primarily of cash, money market funds, cash deposits with commercial banks, and highly rated direct short-term instruments with original maturities of 90 days or less. Our marketable securities are also carried at fair value and include investments in certain highly rated short-term government notes, government bills, commercial paper, and time deposits. As of January 31st, 2026, 2.7 billion of these investments had original maturities in excess of 90 days and less than 1 year and are classified as, quote, marketable securities on our consolidated balance sheets. See, that should be earning like over 4% potentially. So 2.7 billion times 4%, 108 million, and then you do the 6.3 billion times 3.5%. So yeah, almost 350 million potentially. I don't know the exact interest rate on those marketable securities, but it should be over 4% potentially. In fiscal 2025, we reclassified cash and marketable securities associated with French Disposal Group to assets held for sale on the consolidated balance sheet. As of January 31st, 2026, the French Disposal Group included 22.5 million of cash and an immaterial amount of marketable securities within assets held for sale. See Item 1, Part 1, Notes to the Consolidated Financial Statements, Note 11, Fair Value Measurements for additional information. On an ongoing basis, we evaluate and consider certain strategic operating alternatives, including divestitures, restructuring, or dissolution of unprofitable business segments, uses for our excess cash, as well as equity and debt financing alternatives that we believe may enhance stockholder value. The nature, amount, and timing of any strategic operational change or financing transactions that we might pursue will depend on a variety of factors, including, as of the applicable time, our available cash and liquidity and operating performance, our commitments and obligations, our capital requirements, limitations imposed under our credit arrangements, and overall market conditions. On March 18, 2025, the Board of Directors unanimously authorized a revised investment policy, the quote, investment policy. See Item 1, Part 1, Notes to the Consolidated Financial Statements. Note 2, Summary of Significant Accounting Policies for additional information. Gains and losses on marketable securities may fluctuate significantly from period to period in the future and could have a significant impact on the company's results of operations. However, the amount of gain or loss on marketable securities for any given period may have no predictive value, and variation in amount from period to period may have no analytical value. In the first quarter of fiscal 25, we announced that the board approved the addition of Bitcoin as a treasury reserve asset, allowing a portion of our cash or future debt and equity proceeds to be invested in Bitcoin. During the second quarter of fiscal 25, we purchased 4,710 Bitcoin for $500 million. In the fourth quarter of fiscal 25, we entered into an agreement, the quote collateral agreement, with Coinbase Credit Inc., the counterparty, under which we sold covered call options on a portion of Bitcoin we own. In connection with this covered call strategy, we pledged 4,709 Bitcoin and the quote pledged Bitcoin as collateral. Under the terms of the collateral agreement, the counterparty retained the rights to rehypothecate, commingle, or unilaterally sell the pledged Bitcoin. As a result of these rights, we concluded that control of the pledged Bitcoin transferred to the counterparty. Accordingly, we de-recognized the pledged Bitcoin as an intangible asset and recognized digital assets receivable of $368.3 million within digital assets and related receivables on our consolidated balance sheet as of January 31st, 2026, representing our contractual right to receive equivalent amount of Bitcoin in the future. Although the classification of these assets has changed, our economic exposure is consistent with the direct ownership of the underlying Bitcoin. We de-recognize the pledged Bitcoin as an intangible asset and recognize digital assets receivable of 368.3. Interesting. Oh, what's up, Aaron? Hugh G. Moose, what's up? I'll read your message in a minute, Matt. I just gotta get as much reading as I can in here. We recorded an unrealized loss of $59.7 million related to the digital asset receivable during fiscal 25, reflecting the decline in the market price of Bitcoin between the date the Bitcoin was de-recognized and the January 31st, 2026. Wait, so it's $368 million? Is that how much they made from the covered calls? That part confuses me. In fiscal 2021, because they bought $500 million worth of Bitcoin, if they had an unrealized loss of $59.7 million, that would only be $440 million. So how is it $368 million? Like, I'm kind of confused. I'm confused by that. Very confused by that. From like the reading, it seems like the 368 million is how much they made from the covered calls, but like I legit don't know, Because what would 4709 times 70,000? 329 million. Okay, so never mind. That's just interesting language there. And also unrealized loss of 59.7 million, like, should be at 460 million, so I'm just confused by that. In fiscal 2021, 6 separate unsecured term loans held by our French subsidiary Micromania SAS for a total of 40 million euros were extended for 5 years. During the first quarter of fiscal 2025, we reclassified the French term loans to liabilities held for sale on the consolidated balance sheet, where it continues to be measured at the lower of its carrying amount and fair value less cost to sell. As of January 31st, 2026, 7.5 million remains outstanding and classified in, quote, liabilities held for sale. Some of our vendors have requested and may continue to request credit support collateral for our inventory purchase obligations, and the levels of such collateral will depend on a variety of factors, including our inventory purchase levels, available payment terms for inventories, favorable credit terms, and costs of providing collateral. We maintain uncommitted facilities with certain lenders that provide the issuance of letters of credit and bank guarantees, at times supported by cash collateral. As of January 31st, 2026, we had letters of credit and other bank guarantees outstanding in the amount of 6.7 million. At the market equity offering program. On May 17th, 2024, we entered into an open market sale agreement with Jefferies LLC, providing for the sale by the company of shares of our Class A common stock, par value 0.001 per share, from time to time through the sales agent in connection with an at-the-market offering program, the ATM offerings. Pursuant to the prospectus supplement relating to the ATM offerings filed on the SEC, with the SEC on May 17, 2024, we sold an aggregate of 45 million common shares for aggregate gross proceeds before commissions and offering expenses of approximately 933.4 million. Pursuant to the prospectus supplement relating to the ATM offerings filed with the SEC on June 7, 2024, we sold an aggregate of 75 million additional common shares for aggregate gross proceeds before commissions and offering expenses of approximately 2.13 billion. Pursuant to the prospectus supplement relating to the ATM offering filed with the SEC on September 10th, 2024, we sold an aggregate of 20 million additional common shares for aggregate gross proceeds before commissions and offering expenses of approximately 400 million. Yeah, that one's the most interesting one, because they did that at like $21 and the stock didn't even really move. We intend to use the net proceeds from the ATM offerings for general corporate purposes, which may include acquisitions and investments in a manner consistent with the investment policy. Convertible senior notes. On April 1st, 2025, we completed a private offering of 1.5 billion aggregate principal amount of 0% convertible senior notes due 2030, the quote convertible 2030 notes, including the exercise in full of the initial purchaser's option to purchase up to an additional 200 million aggregate principal amount of the convertible 2030 notes. The convertible 2030 notes are general unsecured obligations of the company. The convertible 2030 notes were issued pursuant to an indenture dated April 1st, 2025, between the company and U.S. Bank Trust Company, National Association, the trustee as trustee. On June 17th, 2025, we completed a private offering of 2.25 billion aggregate principal amount of 0% convertible senior notes due 2032, the quote convertible 2032 notes, and collectively with the convertible 2030 notes, the quote convertible notes, pursuant to the purchase agreement between the company and the initial purchaser of the notes, the company granted the initial purchaser an option to purchase for settlement within a period of 13 days from and including the date the notes are first issued, up to an additional $450 million aggregate principal amount of notes. The convertible 2032 notes are general unsecured obligations of the company. The convertible 2032 notes were issued pursuant to an indenture dated June 17, 2025, between the company and the trustee as trustee. See Part 1, Item 8, Notes of the Consolidated Financial Statement, Note 13, quote, Debt of our consolidated financial statements for additional information related to the convertible 2030 notes and the convertible 2032 notes. We intend to use the net proceeds from the convertible 2030 notes for general corporate purposes, including the acquisition of Bitcoin in a manner consistent with the company's investment policy. We intend to use the net proceeds from the convertible 2032 notes for general corporate purposes, including making investments in a manner consistent with the company's investment policy and potential acquisitions. Warrants. On October 7th, 2025, the company announced that the board declared a distribution, the quote warrant distribution, to the holders of the record of company's Class A common stock, quote common stock, and holders of the convertible notes, in the form of warrants to purchase shares of common stock, the quote warrants. The warrants were issued on the terms and conditions described in the warrant agreement as defined below, and were distributed on October 7, 2025, to the record holders of the common stock and the convertible notes as of the close of business on October 3, 2025, the quote record date. Pursuant to the terms of the warrant agreement between the company, Computershare Inc., and its affiliate, Computershare Trust Company, N.A., as a warrant agent, the quote warrant agreement, each holder of record of common stock as of the record date received 1 warrant for every 10 shares of common stock, rounded down to the nearest whole number for any fractional warrant. Holders of the convertible notes also receive warrants on an as-converted basis, in lieu of an adjustment to the conversion rate of the convertible notes, pursuant to the applicable indenture governing the convertible notes. The distribution of the warrants to the convertible note holders was at the same time and on the same terms as holders of a common stock. Holders of the convertible notes will not need to convert the convertible notes into common stock in order to receive the warrants. Each warrant entitles the holder to purchase at the holder's sole and exclusive election at a cash exercise price of $32 per warrant, 1 share of common stock, subject to adjustment pursuant to the provisions of the warrant agreement. Payment for shares of common stock upon exercise of warrants must be in cash. The warrants will expire and cease to be exercisable at 5 p.m. New York City time on October 30th, 2026, the quote expiration date. The number of shares of common stock issuable upon exercise of the warrants is subject to certain anti-dilution adjustments, including for stock dividends, share splits, share combinations, right issuances, other distributions, spin-offs, cash dividends, and tender or exchange offers. The warrants commenced trading on the New York Stock Exchange under the ticker GME/WS on October 8, 2025. In connection with the warrant distribution, the company filed a prospectus supplement dated October 7, 2025, pursuant to the company's existing shelf registration statement on Form S-3 ASR, effective as of October 3, 2025, registering up to 59,153,963 shares of common stock to be issued upon exercise of the warrants. During fiscal 2025, holders exercised 6,717 warrants, resulting in the issuance of 6,717 shares of common stock and cash proceeds of $214,873. Oh wow, so like 2,000 more shares got exercised basically. Because I forget, or 2,500? And it wasn't like 4,200-ish or something. I can't remember. There's like 4,420. I don't remember. Maybe it was less than that. I don't remember. Okay, I need a minute. We've been reading for like 40 minutes straight. I need a minute here. Let's see. So many tests. My last test on April 2nd, but they believe something else is causing my heart palpitations. Try a different medicine through trial and error to see how my body reacts. Like kidney cancer runs through my family and not really want to do that. Good news about my heart not having a big issue. Good, bro, good. Hopefully it's not anything bad. Very weird. Very weird. Very weird. What's up, Moose? What's up, AA Brown? QG, what's up? Digesting the 10K in my lunch. Damn, I want some food. I'm hungry. I should have ate before I hopped on stream, but I decided not to. Dropped off the Zard and Gengar to PSA. Well, good luck, bro. Good luck. I hope you get a 10, bro. Hopefully they don't screw you over. Hopefully they don't screw you. The stock's doing pretty well today. For now. For now. I think we're almost halfway through. Ugh. So much reading, bro. So much reading. All right, let's just get this shit over with, bro. Cash flows. The following table presents a summary of our cash flows from operating, investing, and financing activities, as reflected in the consolidated statements of cash flows. Yeah, 614 by operating activities, bro. That's crazy. They absolutely crushed. They absolutely crushed. Cash used in providing by investing activities, 3 point. I think that's because of the marketable securities. Cash provided by financing activities, that should be the bonds. Exchange rate effective on cash. Net change in cash. Yeah, so wow. Crushed. Operating activities. Cash provided by operating activities was $614.8 million in fiscal 2025, compared to $145.7 million in fiscal 2024. The increase was primarily driven by higher operating income and increased interest income during fiscal 2025. Damn, I was close, bro. My estimate was like 500 to 700 million, right in the center, bro. Right in the center. I'm good at this shit, bro. I'm good at this fundamental analysis thing. What's up, Varley? How you doing, bro? Cash provided by operating activities in fiscal 2024 primarily reflected the impact of net income, a decrease in merchandise inventory, and a decrease in receivables, partially offset by decreases in accounts payable and accrued liabilities. Investing activities. Cash used in investing activities was $3.2 billion in fiscal 25, compared to cash provided by investing activities of $265.1 million in fiscal 24. Cash used in fiscal 25 primarily reflected purchases of marketable securities and the purchase of digital assets, partially offset by proceeds from the sale and maturity of marketable securities. Cash provided by investing activities in fiscal 2024 primarily resulted from the maturity of marketable securities and proceeds from the sale of property and equipment in our Europe segment, partially offset by purchases of marketable securities and routine capital expenditures. What's up, Kenny? Financing activities. Cash provided by financing activities totaled $4.14 billion in fiscal 25, compared to $3.44 billion in fiscal 24. Cash provided by financing activities in fiscal 2025 was driven primarily by $4.2 billion of gross proceeds received by the issuance of convertible debt, partially offset by debt issuance costs related to the convertible notes and warrants, as well as prepayments on our government-guaranteed low-interest French term loans due October 2022 through October 2026. Cash provided by financing activities in fiscal 2024 was driven primarily by 3.4 billion of net proceeds received from the issuance and sale of shares of our Class A common stock under our ATM offerings, partially offset by repayments on our government-guaranteed low-interest French term loans. Share repurchases. On March 4th, 2019, our board of directors approved a share repurchase authorization, allowing us to repurchase up to 300 million of our Class A common stock. The authorization has no expiration date. We did not repurchase shares during fiscal 25, 24, or 23. As of January 31st, 2026, we have 101.3 million remaining under the repurchase authorization. Interesting. Off-balance sheet arrangements. We had no material off-balance sheet arrangements as of January 31st, 2026, other than those disclosed in Item 8, Notes to the Consolidated Financial Statements, Note 16, Commitments and Contingencies. Critical accounting estimates. The preparation of financial statements in conformity with accounting principles generally accepted in the United States of America requires us to make estimates and assumptions that affect the reported amounts of assets and liabilities. Dude, I knew it. Requires us to make estimates and assumptions that affect the reported amounts of assets and liability. Bro, they're reporting less than what it actually is. I guarantee it. I guarantee it, bro. They're making more, and they have more. The disclosure of contingent assets and liabilities at the date of the financial statements and the reported amounts of revenues and expenses during the reported period. In preparing these financial statements, we have made our best estimates and judgments of certain amounts included in the financial statements, giving due consideration to materiality. Changes in the estimates and assumptions used by us could have a significant impact on our financial results, and actual results could differ from those estimates. Dude. I knew it, bro. I knew it. Our senior management has discussed the development and selection of these critical accounting policies, as well as the significant accounting policies disclosed in Item 8, Notes to the Consolidated Financial Statements, Note 2, quote, Summary of Significant Accounting Policies, with the Audit Committee of our Board of Directors. We believe the following accounting policies are the most critical to aid in fully understanding and evaluating our reporting of transactions and events, and the estimates of these policies involve our most difficult, subjective, or complex judgments. Valuations of warrants. During fiscal 25, the company issued warrants to the record holders of the company's Class A common stock and holders of the convertible notes. Each warrant entitles the holder to purchase, at the holder's sole exclusive election, 1 share of common stock at an exercise price, subject to adjustment pursuant to the provision of the warrant agreement of $32. The warrants have been classified as equity in accordance with ASC 815-40 and will expire on October 30th, 2026. It's getting close. Only 7 more months. Only 7 more months till they expire. The valuation of the warrants involves significant judgment, and the company estimated the fair value using the Black-Scholes option pricing model, a level 3 valuation technique under ASC 820, fair value measurements, as there were no readily observable market price for these warrants at the time of issuance. Key inputs used in the model to determine the fair value include the closing stock price of the company on the issuance date, the exercise price, the expiration date, the risk-free rate, the expected dividend yield rate, and volatility. This resulted in an estimated valuation of $2.94 for each warrant. Crazy. I think more towards the top of the earnings report, they also said the shares are worth like $22.10 or something like that. As of January 31st, 2026, the consolidated financial statements reflect $172.9 million aggregate value for the warrants issued, including a non-cash, non-reoccurring interest charge of $42.2 million for the warrants issued to the holders of the convertible 2030 notes and the convertible 2032 notes. Valuation of merchandise inventories. Our merchandise inventories are carried at the lower of cost or market, generally using the average cost method. Under the average cost method, as new product is received from vendors, its current cost is added to the existing cost of product on hand, and this amount is re-averaged over the cumulative units. Pre-owned gaming systems and other products traded in by customers are recorded as inventory at the amount of cash or store credit given to the customer. Wow! Wow, dude. So they have way more inventory than they're posting as well. No way. Because they're ripping people off, you know it. You know they're ripping people off, and then they're selling the console or game for like 2 or 3x what they bought it for. Wow, dude. That's so funny. That's so funny, bro. In valuing the inventory, we are required to make assumptions regarding the necessity of reserves required to value potentially obsolete or overvalued items at the lower of cost or market. We consider quantities on hand, recent sales, potential price protections, and returns to vendors, among other factors, when making these assumptions. Our ability to gauge these factors is dependent upon our ability to forecast customer demand and to provide a well-balanced merchandise assortment. Any inability to forecast customer demand properly could lead to increased costs associated with write-downs of inventory to reflect volumes or pricing of inventory, which we believe represents the net realizable value. A 10% change in our obsolescence reserve percentage at January 31st, 2026 would have affected net earnings by approximately $1.2 million in fiscal 2025. Customer liabilities. Our GameStop Pro Rewards program allows paid members to earn points on purchases that can be redeemed for rewards that include discounts or coupons. We allocate the transaction price between the product and loyalty points earned based on the relative standalone selling prices and expected point redemption. The portion allocated to the loyalty points is initially recorded as deferred revenue and subsequently recognized as revenue upon redemption or expiration. The two primary estimates utilized to record the deferred revenue for loyalty points earned by members are the estimated retail price per point, an estimated amount of points that will never be redeemed, which is a concept known in the retail industry as, quote, breakage. Additionally, we sell gift cards to our customers in our retail stores, through our website, and through selected third parties. At the point of sale, a liability is established for the value of the gift card. We recognize revenue from gift cards when the card is redeemed by the customer and recognize estimated breakage on gift cards in proportion to the historical redemption patterns. The two primary estimates utilized to record the balance sheet liability for loyalty points earned by members are estimated redemption rate and estimated weighted average retail price per point redeemed. We use historical redemption rates experienced under our loyalty program as a basis for estimating the ultimate redemption rate of points earned. We estimate breakage of loyalty points and unredeemed gift cards based on historical redemption rates. The weighted average retail price point per point redeemed is based on our most recent actual loyalty point redemptions and is adjusted as appropriate for recent changes in redemption values, including the mix of rewards redeemed. Our estimate of the amount and timing of gift card redemptions is based primarily on historical transaction experience. We continually evaluate our methodology and assumptions based on developments in redemption patterns, retail price per point redeemed, and other factors. Changes in the ultimate redemption rate and weighted average retail price per point redeemed have the effect of either increasing or decreasing the deferred revenue balance through a current period revenue by an amount estimated to cover the retail value of all points previously earned but not yet redeemed by loyalty program members as of the end of the reporting period. A 10% change in our customer loyalty program redemption rate or a 10% change in our weighted average retail value per point redeemed at January 31st, 2026, in each case would have affected net earnings by approximately $1.3 million in fiscal 2025. A 10% change in our gift card breakage rate at January 31st, 2026 would have affected net earnings by approximately $8.6 million in fiscal 2025. A 10% change in our reservation breakage at January 31st, 2026 would have affected net earnings by approximately $1.5 million in fiscal 2025. Income taxes. We account for income taxes using an asset and liability approach, under which deferred tax assets and liabilities are recognized for the estimated future tax effects of differences between the financial reporting and tax basis of assets and liabilities using enacted tax rates. Because we operate in multiple foreign jurisdictions, our global effective tax rate reflects a blend of the applicable statutory rates in those jurisdictions. On July 4th, 2025, the One Big Beautiful Bill Act was enacted in the United States. The legislation included significant provisions such as the permanent extension of certain provisions of the Tax Cuts and Jobs Act, modifications to the U.S. International Tax Framework, and the restoration of favorable business tax provisions, including the immediate expensing of domestic research and experimental expenditures. These provisions have varying effective dates beginning in 2025 and extending through 2027. Another typo. I think that's the actual first real typo I've seen. I've only seen two where they just didn't hit the space bar. This is the first real typo I've seen, though. While we continue to evaluate the full impact of the legislation, the OBBBA did not have a material effect on our estimated fiscal 2025 effective tax rate. The Organization for Economic Cooperation and Development, OECD, supported by more than 140 countries, has agreed to implement a global minimum corporate tax rate of 15% on certain multinational enterprises under the Pillar 2 framework. These rules began taking across various jurisdictions in 2024 as countries enacted legislation aligned with the OECD model. In fiscal 2025, the company did not incur any Pillar 2 top-up taxes and therefore did not record any related impact to the fiscal 2025 effective tax rate. We'll continue to monitor additional OECD guidance and pending and enacted legislation in the jurisdictions in which we operate. A valuation allowance is recorded when it is more likely than not that some portion of or all of a deferred tax asset will not be realized. In evaluating and realizability of our deferred tax assets, we consider a number of factors, including the remaining years available for the carry forward, applicable tax laws, projected future profitability of specific business units, and feasible tax planning strategies. Based on this evaluation, we concluded that certain deferred tax assets are not more likely than not to be realized. As a result, our valuation and allowances increased by a net of $111.9 million, reaching $403.2 million as of January 31st, 2026. See Item 8, Notes of the Consolidated Financial Statements, Note 15, Income Taxes for additional information. We maintain accruals for uncertain tax positions until the relevant tax years are audited by the applicable tax authorities. The statutory periods for review expire or new information becomes available that affects our assessment. Our liability for uncertain tax positions was $5 million as of January 31st, 2026. Significant judgment is required in evaluating uncertain tax positions due to the inherent complexity of tax laws, varying interpretations among jurisdictions, and the impact of potential changes in tax regulations. Our estimated annual effective tax rate reflects a weighted combination of jurisdictional tax rates and projected income by jurisdiction based on our understanding of applicable tax rules and regulations. Judgments related to uncertain tax positions or the realizability of deferred tax assets may change as a result of new information, tax audits, or changes in tax law. If such changes occur, our effective tax rate could fluctuate in future periods, impacting our net earnings. Recent accounting standards and pronouncements. See item 8, notes to the consolidated financial statement. Note 3, quote, new accounting pronouncements for recent accounting standards and pronouncements. What is this? Oh, that's all the way at the bottom, so we'll get to that eventually. I just lost my spot. No, I just lost my spot. I don't even remember where the fuck I was, dude. I knew I shouldn't have clicked that. Oh, dude, there's still so much to read, too. There's still so much to read, bro. Oh, my God. Kill me. Kill me! Oh, okay, we're actually not that, we're close. Calls are down and flat with this price action. Well, maybe you shouldn't gamble on options like a degenerate. You ever think about that? Of course the calls are down. The stock didn't move. They had premium for earnings. Like, that should be pretty obvious, I feel like. But you shouldn't even be trading options if you're going to cry about it. God, it's fucking stupid, bro. Come on. Come on, Simon. Get your shit together, bro. Get your life together. Alright, let's keep this going. Quantitative and qualitative disclosures about market risk. We are exposed to market risk due to foreign currency fluctuations, as well as volatility associated with our holdings of Bitcoin, described more fully below. Foreign currency risk. We may use forward exchange contracts to manage currency risk primarily associated with intercompany loans denominated in non-functional currencies. The forward contracts are not designated as hedging instruments under ASC 815. Therefore, changes in their fair value are recognized in earnings and offset the current period remeasurement effects of the related intercompany loans. The aggregate fair value of our forward exchange contracts as of January 31st, 2026 and February 1st, 2025 was a net liability of 0 for both periods. Fair value measurements are based on observable market inputs obtained from financial reporting services such as Bloomberg and industry standard valuation models incorporating quoted forward prices, time value, volatility factors, and contractual terms, as well as relevant economic assumptions. As of January 31st, 2026, we had no outstanding derivative contracts, and accordingly, no foreign currency derivative exposure. We do not use derivative financial instruments for trading or speculative purposes. We are exposed to counterparty credit risk on all derivative financial instruments and cash equivalent investments. Counterparty risk is managed in accordance with our risk management and investment policies, which include ongoing monitoring of counterparty financial strength and the use of multiple counterparties to reduce concentration risk. Covered call options. In addition to foreign currency risks, we are exposed to market price volatility associated with our holdings of Bitcoin. To mitigate a portion of this exposure and to generate incremental yield, we employ a covered call strategy by selling Bitcoin call options. These written call option contracts limit our participation in Bitcoin price appreciation above the contractual strike price, while continuing to expose us to the full extent of downward price movements. Premiums received provide only a limited offset to potential losses. The options are freestanding derivative instruments and are not designated as hedging instruments under ASC 815. Oh, I didn't know covered calls weren't considered hedging instruments. I thought they would be. It seems just kind of like common. That seems like it would be like a common sense thing, but I guess it's not. Our covered call contracts are over the counter. Yeah, so that we were talking about this. Only whales are able to get this off of Coinbase, it seems like. But if the futures were correct, they did sell those contracts at like 17,000 a piece or something like that. But who knows if the futures are correct or not. Our covered call contracts are over the counter. Derivatives entered into the Coinbase Credit Inc. and are typically short dated. Under the agreements, Bitcoin is pledged as collateral and can be rehypothecated, repledged, or otherwise deployed by Coinbase. As of January 31st, 2026, we had outstanding covered call option contracts referencing approximately 4,709 Bitcoin, with strike prices ranging from 105,000 to 110,000, and maturities extending through March 27, 2026. These contracts resulted in a derivative liability of $0.7 million as of January 31st, 2026, which is presented within accrued liabilities and other current assets, and an associated unrealized gain of approximately $2.3 million for the period. No derivative assets were recognized as of the reporting date. Premiums received at inception are initially recorded on the consolidated balance sheet and subsequently reflected in earnings consistent with the subsequent fair value change of related options. Subsequent to year-end, a portion of the covered call option contracts expired unexercised, and the related pledge collateral continues to be held by Coinbase Credit Inc. Subsequent to year-end, a portion of the covered call option contracts expired unexercised, and the related pledge collateral continues to be held. So a lot of them have already expired. Maybe that's reflected into the cash balance. Maybe not. I don't know. I don't know. I don't know what they mean by subsequent to year end. Does that mean before year end or after? I don't know. I mean, I guess I could hold up. We got to stop the recording here so I can look up the definition of this. Coming after something. Okay. Okay, so it is after the year end. So yeah, these aren't even on the balance sheet yet. You don't even know how much they made from these covered calls, but I guess we'll find out next quarter. The fair value of these written options is measured using standard option pricing models, incorporating observable market inputs, including Bitcoin spot prices, implied volatility, and time to expiration. As such, the options are classified as level 2 within the fair value hierarchy. Changes in the fair value of the options are recognized in earnings with other, quote, income expense net, classified as non-operating activity. This presentation is consistent with the treatment of fair value changes related to our digital assets and related receivables, which are recognized in earnings within loss on digital assets and related receivables, also classified as non-operating activity. Because the options are written over Bitcoin pledged as collateral and subject to rehypothecation rights held by Coinbase Credit Inc., we are exposed to counterparty credit risk in the event of default. We evaluate this credit exposure each reporting period, considering publicly available financial information, regulatory environment, and other relevant factors. The contracts do not contain credit risk-related contingent features, such as requirements to post additional collateral or early termination rights tied to credit ratings. The company did not record a credit loss allowance associated with these derivative positions as of January 31st, 2026. Nice. All right. Report of an independent registered public accounting firm to the stockholders and the board of directors, Gamestop Corp. Opinions on the consolidated financial statements and internal control over financial reporting. We have audited the accompanying consolidated balance sheet of GameStop Corp. And subsidiaries as of January 31st, 2026. The related consolidated statements of operations, comprehensive income/loss, stockholders' equity, and cash flows for the 52 weeks ended January 31st, 2026, and the related notes, collectively the consolidated financial statements, We also have audited the company's internal control over financial reporting as of January 31st, 2026, based on criteria established in Internal Control Integrated Framework 2013, issued by the Committee of Sponsoring Organizations of the Treadway Commission. In our opinion, the consolidated financial statements referred to above present fairly, in all material respects, the financial position of the company as of January 31st, 2026, and the results of its operations and its cash flows for the 52 weeks ended January 31st, 2026, in conformity with the U.S. generally accepted accounting principles. Also, in our opinion, the company maintained, in all material respects, effective internal control over financial reporting as of January 31st, 2026, based on criteria established in Internal Control Integrated Framework 2013, issued by the Committee of Sponsoring Organization of the Treadway Commission. Basis for opinion. The company's management is responsible for these consolidated financial statements for maintaining effective internal control over financial reporting, and for its assessment of the effectiveness of internal controls over financial reporting, including the accompanying management annual report on internal control over financial reporting. Our responsibility is to express an opinion on the company's consolidated financial statements and an opinion on the company's internal control over financial reporting based on our audits. We are a public accounting firm registered with the Public Company Accounting Oversight Board, United States, PCAOB, and are required to be independent with respect to the company in accordance with the U.S. Federal Securities Law and the applicable rules and regulations of the Securities and Exchange Commission and the PCAOB. We conducted our audits in accordance with the standards of the PCAOB. Those standards require that we plan and perform the audits to obtain reasonable assurance about whether the consolidated financial statements are free of material misstatements, whether due to error or fraud, and whether effective internal control over financial reporting was maintained in all material respects. Our audit of the consolidated financial statements included performing procedures to assess the risks of material misstatement of the consolidated financial statements, whether due to error or fraud, and performing procedures that respond to those risks. Such procedures included examining on a test basis evidence regarding the amount and disclosure in the consolidated financial statements. Our audit also included evaluating the accounting principles used and significant estimates made by management, as well as evaluating the overall presentation of the consolidated financial statements. Our audit of internal control over financial reporting included obtaining an understanding of internal control over financial reporting, assessing the risk that a material weakness exists, and testing and evaluating the design and operating effectiveness of internal control based on assessed risk. Our audits also included performing such other procedures as we considered necessary in the circumstances. We believe that our audits provide a reasonable basis for our opinions. I don't even think this is really that important to read, but whatever. Definitions and limitations of internal control over financial reporting. A company's internal control over financial reporting is a process designed to provide reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements for external purposes in accordance with generally accepted accounting principles. A company's internal control over financial reporting includes those policies and procedures that 1. Pertain to maintenance of records that, in reasonable detail, accurately and fairly reflect the transactions and dispositions of the assets of the company. 2. Provide reasonable assurance that the transactions are recorded as necessary to permit preparation of financial statements in accordance with generally accepted accounting principles, and that receipts and expenditures of the company are being made only in accordance with authorizations of management and directors of the company. And 3, provide reasonable assurance regarding prevention or timely detection of unauthorized acquisition, use or disposition of the company's assets that could have a material effect on the financial statements. Because of its inherent limitations, internal control over financial reporting may not prevent or detect misstatements. Also, projections of any evaluation of effectiveness to future periods are subject to the risks that control may become inadequate because of changes in conditions, or that the degree of compliance with the policies or procedures may deteriorate. Critical audit matter. The critical audit matter communicated below is a matter arising from the current period audit of the consolidated financial statements. Those communicated or required to be communicated to the audit committee, and that 1. Relates to accounts or disclosures that are material to the consolidated financial statements, and 2. Involved in our especially challenging, subjective, or complex judgments. The communication of a critical audit matter does not alter in any way our opinion of the consolidated financial statements taken as a whole, and we are not, by communicating the critical audit matter below, providing a separate opinion on the critical audit matter or on the accounts or disclosures to which it relates. Valuation of warrants. As discussed in Note 2 and 11 to the consolidated financial statements, on October 7, 2025, the company distributed warrants to purchase shares of common stock to the holders of the company's common stock and holders of the company's convertible bonds, convertible notes. The warrants have been classified as equity. The company estimated the fair value of the warrants using the Black-Scholes option pricing model. The key inputs used in the Black-Scholes option pricing model included the company's closing stock price on the valuation date, exercise price, expiration date, risk-free rate, expected dividend yield, and volatility. The aggregate fair value for the warrants was $173.9 million. We identified the evaluation of the fair value of the warrants as a critical audit matter. A high degree of auditor judgment and the involvement of professionals with specialized skills and knowledge were required to evaluate the estimated fair value of the warrants due to the degree of subjectivity associated with the volatility assumption and its sensitivity to variation. The following are primarily procedures we performed to address the critical audit matter. We evaluated the design and tested the operating effectiveness of an internal control related to the company's warrants valuation process, which included the determination of the volatility assumption. We involved valuation professionals with specialized skills and knowledge who assisted in developing an independent expectation of the volatility assumption based on considerations of historical and implied share price volatility information. Developing an independent estimate of the fair value of the warrants as of October 7, 2025, using independently developed assumptions including volatility, and comparing the independently developed estimate of fair value to the respective fair value for the warrants as of October 7, 2025, used by management. We have served as the company's auditor since 2025. KPMG. Yep. Report of the independent registered public accounting firm to the stockholders and board of directors of GameStop Corp. Opinion on the financial statement. We have audited the accompanying consolidated balance sheet of GameStop Corp. Wait, is this just the same thing? Hold up. If this is just the same thing but a different company, I don't think I want to read this again. Pretty sure it's the same exact thing because they get audited by multiple. Whatever, I'll just fucking read it. We've already read this whole fucking thing. We might as well just read it, right? We might as well just read it. You can do it! Oh, the stock was up for a little bit. That's why a bunch of people came in and left. Interesting. It's funny how people only care about the share price. They don't care about like actual business and like what they're investing in. It's like, the price on the screen's not going up. That's stupid. It's manipulated. My calls aren't gaining value. Like, come on, bro. Come on, bro. There's more to this than just a number on a screen. More than this than just a number on a fucking screen, bro. I've already been reading for over an hour, bro. We're so close to the end. So close yet so far. There's still a lot. There's still a lot. But we're so close to the end. We're like right there. We're at the home stretch here. Probably another like hour or two. Oh, all right. Let's fucking do it, bro. Report of independent registered public accounting firm to the stockholders and the board of directors of GameStop. Opinion on the financial statement. We have audited the accompanying consolidated balance sheet of GameStop Corp. And the subsidiaries, the quote company, as of February 1st, 2025. The related consolidated statements of operations, comprehensive loss, stockholder equity, and cash flows for the 52 weeks ended February 1st, 2025, and the 53 weeks ended February 3rd, 2024, and the related notes in the schedule listed in the index at item 15, collectively referred to as, quote, financial statements. In our opinion, the financial statements present fairly, in all material respects, the financial position of the company as of February 1st, 2025, and the results of its operations and its cash flows for the 52 weeks ended February 1st, 2025, and the 53 weeks ended February 3rd, 2024, in conformity with the accounting principles generally accepted in the United States. Oh, this is the audit company that did their audit in 25 and 24. I get why they have two different audit things now. That makes sense. Basis for opinion. These financial statements are the responsibility of the company's management. Our responsibility is to express an opinion on the company's financial statements based on our audits. We are a public accounting firm registered with the PCAOB and are required to be independent with respect to the company in accordance with the U.S. federal securities laws and the applicable rules and regulations of the Securities and Exchange Commission and the PCAOB. We conducted our audits in accordance with the standards of the PCAOB. Those standards require that we plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatement, whether due to error or fraud. Our audits included performing procedures to assess the risks of material misstatement of the financial statements, whether due to error or fraud, and performing procedures that respond to those risks. Such procedures included examining on a test basis evidence regarding the amounts and disclosures in the financial statements. Our audits also included evaluating the accounting principles used and significant estimates made by management, as well as evaluating the overall presentation of the financial statements. We believe that our audits provide a reasonable basis for our opinion. Deloitte and Touche. We have served as the company's auditors from 2013 to 2024. Okay, so that's okay. That makes sense why there's multiple auditors, because the KPMG or whatever it is new. This is balance sheet, statement of operations, income. I mean, we've already gone through all this. Cash flow statement. Looks all good. It looks all good. Supplemental non-cash investing activities. During the fourth quarter of fiscal 2025, The company pledged 4,709 Bitcoin as collateral for a covered call strategy, resulting in the derecognition of digital assets and the recognition of digital asset receivables with a fair value of 428 million as of the date of recognition and 368.3 million as of January 31st, 2026. Recognition of a digital assets receivable. See, I don't understand what that means. I guess they just changed, maybe it's just how much the Bitcoin's worth and they just changed the term, but if that's how much they made off the covered calls, that's insane. I don't know if that's it though. I don't think that's right. All right. Notes to the consolidated financial statements. GameStop Corp., a Delaware corporation established in 1996, is a leading specialty retailer offering games, collectibles, and entertainment products. Effective May 4th, 2025, we operate our business in 3 geographic segments: United States, Australia, and Europe. During the second quarter of fiscal 25, we divested our operations in Canada, which previously comprised a 4th separate reporting segment. This information contained in these consolidated financial statements refers to continuing operations unless otherwise noted. See Note 5, quote, segment information for additional info. Basis of presentation and consolidation. Our consolidated financial statements include our accounts and the accounts of our wholly owned subsidiaries. All intercompany accounts and transactions have been eliminated in consolidation. The consolidated financial statements included herein reflects all adjustments, consisting only of normal reoccurring adjustments, which are, in our opinion, necessary for a fair presentation of the information for the periods presented. These consolidated financial statements have been prepared in accordance with accounting principles generally accepted in the United States of America. GAAP, as codified in the Financial Accounting Standards Board's FASB Accounting Standards Codification, ASC, certain amounts in the consolidated financial statements and notes thereto or prior years have been reclassified to conform to the current presentation. Our fiscal year is composed of 52 or 53 weeks ending on Saturday, closer to the last day of January. Fiscal year 2025 consisted of the 52 weeks ended on January 31st, 2026. Fiscal 25. Fiscal year 2024 consisted of the 52 weeks ended on February 1st, 2025. Fiscal 24. Fiscal year 2023 consisted of the 53 weeks ended on February 3rd, 2024. Fiscal 2023. I think this is kind of just a repeat of everything we already read, but whatever. At the Market Equity Offering Program, on May 17, 2024, we entered into an open market sale agreement with Jefferies LLC, providing for the sale by the company of shares of our Class A common stock, par value 0.001 per share, from time to time through the sales agent in connection with an at-the-market equity offering program. Pursuant to the prospectus supplement relating to the ATM offerings filed with the SEC on May 17, 2024, we sold an aggregate of 45 million common shares for aggregate gross proceeds before commissions and offering expenses of approximately 933 million. Pursuant to the prospectus supplement relating to the ATM offering filed with the SEC on June 7, 2024, we sold an additional aggregate 75 million common shares for aggregate gross proceeds before commissions and offering expenses of approximately 2.13 billion. Pursuant to the prospectus supplement relating to the ATM offering filed with the SEC on September 10, 2024, we sold an additional aggregate of 20 million common shares for aggregate gross proceeds before commissions and offering expenses of approximately 400 million. Convertible senior notes. On April 1st, 2025, we completed a private offering of 1.5 billion aggregate principal amount of 0% convertible senior notes due 2030, the convertible 2030 notes, including the exercise in full of initial purchaser's option to purchase up to an additional $200 million aggregate principal amount of the convertible 2030 notes. The convertible 2030 notes are a general unsecured obligation of the company. The convertible 2030 notes were issued pursuant to an indenture dated April 1st, 2025, between the company and the U.S. Bank Trust Company, National Association, the trustee, as trustee. On June 17th, 2025, we completed a private offering of $2.25 billion aggregate principal amount of 0% convertible senior notes due 2032. The quote convertible 2032 notes, and collectively with the 2030 notes, the convertible notes. Pursuant to the purchase agreement between the company and the initial purchaser of the notes, the company granted the initial purchaser an option to purchase for settlement with a period of 13 days from and including the date the notes are first issued, up to an additional $450 million aggregate principal amount of notes, the quote additional notes, on June 23rd, 2025. The initial purchaser elected to exercise in full such option, and on June 24th, 2025, the company issued the full aggregate principal amount of the additional notes. The convertible 2032 notes are a general unsecured obligation of the company. The convertible 2032 notes were issued pursuant to an indenture dated June 17, 2025, between the company and the trustee, as trustee. Warrants. On October 7, 2025, company announced the board of... Fuck, I need a minute, bro. I'm dying. Too much reading. It's too much. I'm kind of sick of this. Can't wait till it's over. We haven't even gotten to any good part. I mean, I don't know if there's any more like new information. I think the rest of it might just be what we've already read. Because I think the first part's the audited part, and then this part is what GameStop reported, or maybe vice versa. I'm not exactly sure. There's still a lot though. There's still a lot. Oh no, this is just more info. A little bit more info. Some of it's repeating the same shit. It's probably to like, I don't know, maybe they don't want, maybe it's for lazy people. Lazy people don't want to read the same thing 4 times in a row. I can imagine someone else reading this be like, this is stupid, it's just repeating the same thing over again, I ain't reading this. Then they miss out on all the little details they have scattered throughout it. Man, oh man. I need a break from reading for a second here. Let's see if there's anything on Reddit, even though we all know the answer to that. It's a big fat no. Michael Burry predicts a 77% market crash. I don't even think that's real, but okay. Why is Super Stonk the most fucking trash place ever? Like, there's no valuable information there. You would think it would be like a place where people like post GameStop things and like GameStop related things and like maybe bring some value, but it's just complete dog shit that just gets posted. Like every like 1 in 1,000 posts is useful. White House says Trump will meet Xi in China in May. Jury in Los Angeles finds Meta YouTube negligent in social media addiction trial. Meta cutting several hundred jobs across Reality Labs, Facebook, and other departments. I'm just reading other shit. I might as well just finish reading the fucking the thing. Trump says he could send National Guard to airports. SpaceX's imminent IPO filing. When is that IPO? No date. Don't look like there's a date for that. Single women outpace single men as home buyers, seeing it as a wealth building tool. Well, no offense, but if you think buying a home is a wealth building tool, you're probably not that smart. Sorry to say. Maybe in like 40 years you might benefit from your real estate purchase, but nah, buying a house is a stupid idea, bro. Literally. Buying a house is so dumb. That is not a fucking well. Maybe like 10, 20 years ago, maybe I would agree that it was a wealth building tool, but I don't know about in today's world. I think real estate's fucked for the next like 10, 15 years. Eventually it will appreciate, but not enough. Not enough. I would rather buy stocks and just sell covered calls, honestly. I'd rather, yeah, I think buying a house is dumb. I think buying a house is dumb. Like, you can literally just make income by having money. There's no point in buying a house in today's economy. Unless you're like flipping it or something and you get a good deal on it. But if you're just going to buy a house and you don't know what you're doing, yeah, you probably don't know. You probably just don't know what you're doing. Malfunctioning robot slaps child. That's kind of funny. That's kind of funny. I probably won't be able to watch the video. Oh, here's the video. Let's see this robot. Yeah, that kid got like a pimp slapped by the robot. Meta and YouTube ordered to pay $3 million after woman sues platforms for social media addiction. What? That's all you got to do to get rich is claim that Meta and YouTube gave you a social media addiction? You don't even have to take responsibility for your own actions anymore? That's crazy. That's crazy. MLB fans can score free Mountain Dew Baja Blast every time a 420-foot home run is hit. Nice. Pokemon. Oh yeah, I guess they're making a new Pokemon Stadium game. Pokemon Champions. At least it looks like Pokemon Stadium. Mr. Beast reveals he lost $1 million per day when bad weather delayed Beast games. VTuber charges $600 a month for quote girlfriend experience. This world is fucking trash, dude. Like what simp ass man? Like not even a man. Like what simp is? I want to have the girlfriend experience. Fucking losers, bro. Fucking losers, bro. I want the girlfriend experience. GameStop will pay you $69 to ditch PlayStation for Xbox. That's interesting. Interesting. Man, that's a stream clip right there, bro. I'm over here reading a 10K that nobody's even gonna watch because they're too lazy to research their investment properly. I could just make this. Man, what am I doing with my life? I should just be making things up like everyone else. 12K ticket will let fans make pasta with favorite wrestlers in Italy. Okay. Man arrested for 98th time. 98th time. That's... How do you get arrested 98 times? That's also something I could be doing. I could just be committing crime. Like, crime is legal these days. You just don't even have to be, like, a real, like, good person in today's world. You can just be a piece of shit. You just talk out your ass. And you'll be more successful than someone who, is just, like, a normal good person. What a fucked up world we live in, bro. What a fucked up world. One Piece Lego set dropping August 26th. Squirrel caught vaping. Okay. I might have to stop reading news, bro. There's just nothing good. I just have to stick to GameStop shit. What's up, Kev? Alright, let's fucking finish this, bro. Let's finish this. Let's get this shit over with. Warrants. On October 7th, 2025, the company announced that the board declared a distribution, the quote, warrant distribution, to holders of record of the company's Class A common stock and holders of the convertible notes in the form of warrants to purchase shares of common stock. The warrants were issued on the terms and conditions described in the warrant agreement and were distributed on October 7th, 2025 to the record holders of the common stock and the convertible notes as of the close of business on October 3rd, 2025. Pursuant to the terms of the warrant agreement between the company, Computershare Inc., a Delaware Corp., and its affiliate, Computershare Trust Company, N.A., as warrant agent, the quote warrant agreement, each holder of record of common stock as of the record date received one warrant for every 10 shares of common stock, rounded down to the nearest whole number for any fractional warrants. Holders of the convertible notes also received warrants on an as-converted basis in lieu of an adjustment to the conversion rate of the convertible notes, pursuant to the applicable indenture governing the convertible notes. The distribution of the warrants to the convertible note holders was at the same time and on the same terms as holders of the common stock. Holders of the convertible notes will not need to convert the convertible notes into common stock in order to receive the warrants. Use of estimates. The preparation of the consolidated financial statements and accompanying footnotes in conformity with accounting principles generally accepted in the United States of America, GAAP, requires us to make estimates and assumptions that affect the amounts reported as and disclosed. We regularly evaluate the estimates related to our assets and liabilities, contingent assets and liabilities, and the reported amounts of revenues and expenses. In preparing these financial statements, we have made our best estimates and judgments of certain amounts included in the consolidated financial statements. giving due consideration to materiality. I said that wrong, but whatever. Changes in the estimates and assumptions used by us could have a significant impact on our financial results. Actual results could differ from those estimates. Summary of significant accounting policies. Cash and cash equivalents and restricted cash. Our cash and cash equivalents on our consolidated balance sheets are carried at cost, which approximates fair value and consists primarily of cash, money market funds, cash deposits with commercial banks, and highly rated direct short-term instruments with an original maturity of 90 days or less. Our restricted cash is also carried at cost, which approximates fair value and consists primarily of bank deposits that collateralize our obligations to vendors and landlords. Following table represents a conciliation of cash, cash equivalents, and restricted cash in our consolidated balance sheets to total cash, cash equivalents, and restricted cash in our consolidated statement of cash flow. I swear I already read this, but whatever. 6.3 billion cash, 3.7 million restricted cash, and 19.7 million long-term restricted cash, which total is 2.6 billion above last year. Pretty impressive, even though a lot of it's from bonds and stuff. Investments. We have invested a portion of our excess cash into investment-grade short-term fixed income securities, which primarily consist of U.S. government and agency securities, commercial paper, as well as time deposits. Investments with an original maturity greater than 90 days, but less than 1 year, are classified as marketable securities on our consolidated balance sheets. We classify these investments as available for sale debt securities and record them at fair value. Unrealized holding gains and losses are recognized in accumulated other comprehensive loss on our consolidated balance sheets. Realized gains and losses upon sale or extinguishment are reported in other income expenses net in our consolidated statements of operations. Each reporting period, we evaluate declines in fair value to determine whether they are attributable to expected credit losses and assess our ability and intent to hold the investment until recovery. On March 18, 2025, our board of directors, the board, unanimously authorized a revised investment policy, the investment policy. In accordance with the investment policy, the board has delegated authority to manage the company's investments and liquidity to an investment committee of the board, the quote investment committee, consisting of the company's chairman, chief executive officer Ryan Cohen, as well as 2 independent members of the board, together with such personnel and advisors as the investment committee deems appropriate. I wish I told you who the other 2 members are. On March 25th, 2025, we announced that as part of our revisions to the investment policy, the board approved the addition of Bitcoin as a treasury reserve asset, whereby a portion of our cash or future debt and equity issuances may be held in Bitcoin. Such investments are classified as digital assets on our consolidated balance sheets and are recorded at fair value. See quote digital assets section below for additional information. The investment committee regularly reviews risks related to the company's investments, including concentration risk, in allocating capital among investment opportunities, and evaluating related investment risk. The investment committee considers market-based factors, including risk-adjusted after-tax yields, as well as the company's overall liquidity requirements. I think we already read a lot of this, but whatever. Merchandise and inventories. Our merchandise inventories are carried at the lower of cost or net realizable value, generally using the average cost method. Under the average cost method, as new product is received from vendors, its current cost is added to the existing cost of product on hand, and this amount is re-averaged over the cumulative units. Pre-owned gaming systems and other products traded by customers are recorded as inventory at the amount of cash or store credit given to the customer. We are required to make adjustments to inventory to reflect potential obsolescence or overvaluation as a result of cost exceeding market. In valuing inventory, we consider quantities on hand, recent sales, potential price protections, returns to vendors, and other factors. Our ability to assess these factors is dependent upon our ability to forecast customer demand and to provide a well-balanced merchandise assortment. Inventory is adjusted based on anticipated physical inventory losses, or shrinkage, and actual losses resulting from periodic physical inventory counts. Inventory reserves as of January 31st, 2026 and February 1st, 2025 were $24.3 million and $24.5 million respectively. Property and equipment. Property and equipment are carried at cost less accumulated depreciation and amortization. Depreciation on fixtures and equipment is computed using the straight line method over their estimated useful lives. Maintenance and repairs are expected as incurred, while improvements and major remodeling costs are capitalized. Leasehold improvements are capitalized and amortized over the shorter of their estimated useful lives, or the terms of their respective leases, which includes reasonably certain renewal options. Costs incurred in purchasing or developing management information systems are capitalized and included in fixtures and equipment. These costs are amortized over their estimated useful lives from the date that the technology becomes operational. We periodically review our property and equipment when events or changes in circumstances indicate that its carrying amount may not be recoverable or its depreciation or amortization period should be accelerated. We assess recoverability based on several factors, including our intention with respect to our stores and those stores' projected undiscounted cash flows. An impairment loss is recognized for the amount of which the carrying amount of the assets exceed its fair value, determined based on an estimate of discontinued future cash flows or readily available market information for similar assets. Assets held for sale. We consider assets to be held for sale when management, with appropriate authority, approves and commits to a formal plan to actively market the assets for sale at a price reasonable to the relation to their estimated fair value. The assets are available for immediate sale in their present condition. An active program to locate a buyer has been initiated. The sale of the assets is probable and expected to be completed within 1 year. Now, see, that's good to know because they have like over 300 million in liabilities and assets for sale, so those should be completed in a year, and that's just another 300 million that just goes right in GameStop's pocket. And it is unlikely that significant changes will be made to the plan. Upon designation as held for sale, we record the assets at the lower of their carrying value or their estimated fair value, reduced for the cost to dispose the assets. As part of our efforts to maximize profitability and streamline our international footprint, we continue to evaluate our non-U.S. assets to assess their strategic relevance. During the first quarter of fiscal 2025, management approved a plan to divest the company's operations in Canada. As a result, all related assets and liabilities, the quote Canadian Disposal Group, were reclassified as held for sale, and an impairment expense of $18.3 million was recorded. In the second quarter of fiscal 2025, we completed the sale of our Canadian subsidiary, Electronic Boutique Canada Inc., which operated our Canadian stores and e-commerce business. The related loss on disposal was recorded within asset impairments in our consolidated statement of operations. Both the proceeds from the sale and loss on disposal were immaterial to our financial statements. Also, during the first quarter of fiscal 2025, management approved a plan to divest the company's operations in France. Accordingly, all relevant assets and liabilities of the French Disposal Group were reclassified as held for sale, and we recorded an impairment charge of $17.2 million. Subsequent remeasurement adjustments resulted in additional impairments, charges of $12.6 million during fiscal 2025. These adjustments reflected changes in the estimated fair value of the French Disposal Group, including impacts associated with the amounts recorded in accumulated other comprehensive income. As of January 31st, 2026, The French disposal group included 146.5 million in assets held for sale and 136.1 million in liabilities held for sale. The sale of the French operations is expected to be completed within the next 12 months. Awesome, awesome. You gotta love that. Gotta love that. Digital assets. In December 2023, the Financial Accounting Standards Board, FASB, issued ASU number 2023-08, Intangibles, Goodwill, and Other Crypto Assets, subtopic 350-60, Accounting and Disclosure of Crypto Assets, ASU 2023-08. ASU 2023-08 requires a certain crypto asset, such as Bitcoin, to be measured at fair value at each reporting date, with changes in fair value recognized in earnings, and to be presented separately from other intangible assets, together with enhanced disclosure, including the name, number of units, cost basis, and fair value for each significant crypto asset holding. The standard is effective for fiscal years beginning after December 15, 2024, including interim periods therein. Early adoption is permitted. We adopted ASU 2023-08 on a modified retrospective basis, effective February 2nd, 2025. The company did not hold material crypto assets immediately prior to adoption. Accordingly, the cumulative effect adjustment to opening retained earnings and the impact of our consolidated balance sheet were immaterial. Following adoption, the company measures its in-scope digital assets at fair value under ASC 350-60, with fair value determined in accordance with ASC 820. Bitcoin is initially recorded at cost and subsequently remeasured using unadjusted quoted prices in the principal market that we have identified for Bitcoin, currently the Coinbase exchange, which we consider an active market. Because the fair value is derived from quoted prices for an identical asset in an active market, Bitcoin is classified within level 1 of the fair value hierarchy. Unrealized gains and losses from changes in Bitcoin's fair value are recognized in the consolidated statements of operations as, quote, loss on digital assets and related receivables, and are presented as non-operating activity. On January 16, 2026, the company entered into an agreement, the, quote, collateral agreement with Coinbase Credit, Inc., the counterparty, under which the company sold covered call options on a portion of the Bitcoin it owns. On January 16th, that was like right before Bitcoin went to 80K, I think. The options are accounted for as derivatives under ASC 815 and are not designated as hedging instruments. Our covered call contracts are over-the-counter derivatives entered into with Coinbase Credit, Inc., and are typically short-dated. Under the agreements, Bitcoin is pledged as collateral and can be rehypothecated, repledged, or otherwise deployed by Coinbase. As of January 31st, 2026, we had outstanding covered call option contracts referencing approximately 4,709 Bitcoin, with strike prices ranging from 105,000 to 110,000, and maturities extending through March 27, 2026. These contracts resulted in a derivative liability of $0.7 million as of January 31st, 2026, which is presented within accrued liabilities and other current liabilities, and an associated unrealized gain of approximately $2.3 million for the period. No derivative assets were recognized as of the reporting date. Premiums received at inception are initially recorded on the consolidated balance sheets and subsequently reflected in earnings consistent with the subsequent fair value changes of the related options. Subsequent to year-end, a portion of the covered call option contracts expired unexercised, and the related pledge collateral continues to be held by Coinbase Credit, Inc. The fair value of these written options is measured using standard option pricing models incorporating observable market inputs, including Bitcoin spot price, implied volatility, and time to expiration. As such, the options are classified as level 2 within the fair value hierarchy Changes in the fair value of the options are recognized in earnings with other income expense net, classified as non-operating activity. This presentation is consistent with the treatment of fair value changes related to our digital assets and related receivables, which are recognized in earnings with loss on digital assets and related receivables, also classified as non-operating income. I actually looked at this and it was like 12 million, so as of January 31st, they were up 12 million on their covered calls, I believe. You know, how much those are actually worth, still to be determined. And this part's interesting. So did they sell the covered calls on January 16th, or is that just when they entered the collateral agreement with Coinbase? Because if you were to sell a covered call, you wouldn't go into a collateral agreement. So I don't know if this is something separate from the covered call, and they're using Bitcoin as like almost like if you were to, you know, lend your shares out to someone. Are they lending their Bitcoin to Coinbase Credit for yield? I'm not sure. Pledge of Bitcoin as collateral. In connection with the covered call strategy, so this pledging the Bitcoin is something else. I think this is lending the Bitcoin for yield, potentially. So not only did they do the covered call strategy, they also lended their Bitcoin, basically. Maybe I'm reading it wrong, but I'm thinking that's what they did here. In connection with the covered call strategy, the company pledged 4,709 Bitcoin, the quote pledged Bitcoin as collateral. Per the terms of the collateral agreement, the counterparty maintained the right to rehypothecate, commingle, or unilaterally sell the pledged Bitcoin, and the company concluded that control transferred to the counterparty with respect to the pledged Bitcoin. Accordingly, the company derecognized the pledged Bitcoin as an intangible asset and recognized digital assets receivable on its consolidated balance sheets as of January 31st, 2026, representing the fair value of its contractual right to receive equivalent Bitcoin in the future. The digital assets receivable is due within the next 12 months, and accordingly is classified as a current asset. See, I think they lent out the Bitcoin for yield. That's what it seems like, because they're going to get this Bitcoin back in 12 months. The digital assets receivable is remeasured at fair value at each reporting date in accordance with the ASC 820. The receivables fair value is determined using level 2 inputs, specifically the unadjusted quoted prices in active markets for the underlying crypto asset, Bitcoin. While the value of the receivable is directly derived from the market price of Bitcoin, the receivable itself is not a traded instrument. Therefore, it is classified within level 2 of the fair value hierarchy. Changes in the fair value of the digital assets receivable are recognized with loss on digital assets and related receivables in the consolidated statements of operations and are presented as non-operating activity. Warrants. Warrants again. On October 7th, 2025, the company announced that the board declared a distribution, the warrant distribution, to the holders of record of the company's Class A common stock, par value 0.001 per share, common stock, and holders of the company's 0% convertible senior notes due 2030 and 0% convertible senior notes due 2032, the convertible notes, in the form of warrants to purchase shares of common stock, the warrants. The warrants were issued on the terms and conditions described in a warrant agreement as defined below, and were distributed on October 7th, 2025, to the record holders of the common stock and the convertible notes as of the close of business on October 3rd, 2025, the quote record date. Pursuant to the terms of the warrant agreement, dated as of October 7th, 2025, between the company, Computershare Inc., a Delaware Corp., and its affiliate, Computershare Trust Company, N.A., as warrant agent, the warrant agreement. Each holder of record of common stock as of the record date received 1 warrant for every 10 shares of common stock, rounded down to the nearest whole number for any fractional warrant. Holders of our 0% convertible senior notes due 2030, the convertible 2030 notes, and 0% convertible senior notes due 2032, convertible 2032 notes, and collectively the convertible 2030 notes, the convertible notes, also receive warrants on an as-converted basis in lieu of an adjustment to the respective conversion rates for each of the convertible notes, pursuant to the applicable indentures governing the convertible notes. The distribution of the warrants to the holders of the convertible notes was at the same time and on the same terms as holders of common stock. Holders of the convertible notes will not need to convert the convertible notes into common stock in order to receive the warrants. Them having the warrants in here so many times just makes me think that they're going to do it again at some point. Each warrant entitles the holder to purchase, at the holder's sole discretion and exclusive election, at a cash exercise price of $32 per warrant, the quote exercise price, 1 share of common stock, subject to adjustment pursuant to the provisions of the warrant agreement. Payment for the shares of common stock upon exercise of the warrants must be in cash. The warrants will expire and cease to be exercisable at 5 p.m. New York City time on October 30th, 2026, the quote expiration date. The warrants have been classified as equity in accordance with ASC 81540, primarily due to the following factors. The warrants provide for the purchase of a fixed number of shares at a fixed exercise price. 2. The company is not obligated under the warrant agreement to net cash settle the warrants, except in the case of the liquidation of the company. And 3. The company has sufficient authorized and unissued shares of common stock available to settle the warrants after considering all other common stock commitments. The company estimates the fair value of the warrants using the Black-Scholes option pricing model level 3, using the following key inputs: closing stock price on the valuation date of October 7, 2025, $24.35. Exercise price, $32. Expiration date, October 30th, 2026. 4. Risk-free rate, 3.6%. And 5. Expected dividend yield, 0. And volatility, 50%. The estimated fair value of each warrant on the issuance date was 2.94, and the $173.9 million aggregate fair value of the warrants was recorded as additional paid-in capital. Of this aggregate fair value amount of the warrants, $42.2 million was distributed to the holders of the convertible note and recognized as interest expense, and $131.7 million was distributed to stockholders and recorded to retained earnings. During fiscal 2025, holders exercised 6,717 warrants, resulting in issuance of 6,717 shares of common stock and cash proceeds of $214,873. Isn't that crazy that people are exercising their warrants? The stock's trading at $23 and people are willing to buy it at $32. Like, that's pretty interesting. The number of shares of common stock issuable upon exercise of the warrants is subject to certain anti-dilution adjustments, including for stock dividends, share splits, share combinations, right issuances, other distributions, spin-offs, cash dividends, and tender or exchange offers. The warrants commenced trading on the New York Stock Exchange under the ticker GMEWS on October 8, 2025. In connection with the warrant distribution, the company has filed a prospectus supplement dated October 7, 2025, pursuant to the company's existing shelf registration statement on Form S-3, ASR, effective as of October 3, 2025, registering up to 59,153,963 shares of common stock to be issued upon exercise of the warrants. Alright, I need a break, bro. I need a break. We're so close. We're so close to the end, bro. We're so close to the end. They're using it as collateral to sell covered calls through Coinbase, aiming to earn extra income premiums on their Bitcoin treasury while capping some upside in exchange for that yield. Yeah, but they have the collateral. They did the collateral later, and a lot of the covered calls are already sold or exercised, so why would they have 4,900, or why would they have basically all their Bitcoin as collateral for covered calls when a lot of the covered calls is expired already? So I don't know. And also, you don't have to, when you sell a covered call, you're not necessarily putting your shares or anything up for collateral. The only way you have to sell your, well, in this case, Bitcoin, is if on the expiration date the covered calls are trading below the strike price. So you don't necessarily need, I mean, maybe it's for the covered calls, but I don't know. I don't really get it either. The wordage is weird. But January 16th would have been in fourth quarter, so I guess it could be. Like, I just legit don't know, man. The wordage in it is weird. Shares are $23, but here's a 32. Or do they exercise the warrant and just pay market price? No, you have to pay $32 if you exercise the warrant. So I think there's just some people out there that just don't care. I mean, I guess technically you're putting your shares up for collateral, but I don't know. I don't know. I mean, let's look at where was Bitcoin at on January 16th? So January 16th, you were already trading at 80K. They did the covered call sales for 105K to 110K. So I think they did the covered call sales back here in October. So for them to pledge the Bitcoin as collateral during January, when Bitcoin was already down, that just makes me think that they lended it, or quote unquote pledged it. Maybe I mean, what does pledging Bitcoin mean? Pledging Bitcoin refers to the process of committing Bitcoin to a specific address or pool without actually sending it. This can be done through various mechanisms, such as escrow accounts or staking pools, where the Bitcoin is locked and can be used to participate in network operations or earn rewards. Pledging Bitcoin can also involve creating a pledge transaction that allows others to contribute funds to a transaction, ensuring that the total amount of Bitcoin is equal to the sum of inputs. This can be useful for maintaining the integrity of a transaction and ensuring that all parties have equal rights to the Bitcoin pledged. Borrowing against cryptocurrency lets you tap value of your holdings without selling them, which means you skip the capital gains tax bill that a sell would trigger. Most centralized and decentralized platforms offer loans worth 30 to 70% of your crypto market value, with annual interest rates that currently range from roughly 5 to 16%. Process works like any secured loan. You pledge an asset, receive cash. So they pledged the Bitcoin. So they got like 400 million cash by pledging the Bitcoin. It's not a yield thing. It's like a loan. Oh, shit. Interesting. Assuming that's correct. assuming that's correct, you pledge an asset, receive cash or stable coins, pay interest, and you get your collateral back when you repay. Okay. That makes more sense. Yeah, that's gangster. That's gangster. So it's another loan, basically. Potentially. Interest begins accruing as soon as your loan's funded. Annual rates across major platforms in 2026 range from about 5% in short-term loans to over 16%. Larger loans tend to qualify for lower rates. Interest is typically calculated daily, even when expressed as an annual rate, so your balance grows continuously. Once your balance hits zero, your collateral is released. Yeah, I think they got a loan on the Bitcoin, which is fucking awesome. Oh. And also, there wasn't like full on panic quite yet. Dude, January 16th? That was the day ever. Oh my god. Bro. Ryan Cohen's a fucking gangster, dude. Holy shit. He did it at the perfect time. Literally. January 16th, like this week, January 12th to January 20th. Well, we'll say to January 16th, literally. Probably was when people were like, yeah, it's going back. We're back, baby. We're back. So I bet they got a good-ass term on the pledge, too. Or a good-ass rate. Oh, bro. What a fucking baller, dude. What an absolute baller. What an absolute baller, bro. Sells covered calls and then immediate... and then pledges it for a loan? Oh my god, what a fucking gangster, bro. What an absolute gangster. They recognized the pledged Bitcoin from their balance sheet, removed it as an asset. They recorded a digital asset receipt. Yeah, I read that. This move also helped them recognize some losses on paper while generating yield to offset Bitcoin's volatility. So do you think the 368 million is the loan then? Like, is that how much they got from pledging the Bitcoin? Because digital asset receivable, that makes so much more sense. That makes so much more sense. I think that's how much money they got from the pledge, and it should potentially go up and down as Bitcoin moves. If Bitcoin goes up, potentially the pledge could be more valuable, and then the loan's like 400 million maybe. I don't know. That's what it seems like now. Now that I've actually read more, it seems like that's what they did, is they got a loan for their Bitcoin, and they literally did it at like the perfect moment. Still trying to get my head around it. It's interesting though. Well, if you research more and you figure it out, let me know. But I think that's what they did. I think they loaned out the Bitcoin. God, that's fucking genius, bro. That's absolutely genius. Probably to help fund the acquisition or something. Who knows? Because I mean, I guess it depends what interest they got on the loan as well, because that little article we read said the more Bitcoin you have, the less interest you get, and it's between 5 and 16%, so potentially they're getting 5% or less interest on that loan, so they can just cover it by holding the cash, and they've already covered a lot of it by selling the covered call. Oh, that's interesting. I can't wait till the next quarter. I can't wait till the next quarter. There's some interesting stuff going on. Interesting stuff. All I know is Ryan Cohen's a straight up gangster, bro. Intangible assets. Indefinite lived intangible assets, which consist primarily of our trade names, are expected to contribute to cash flows indefinitely and therefore are not amortized. These assets are required to be evaluated for impairment at least annually, or more frequently if events or circumstances indicate that their carrying value may not be recoverable. An indefinite lived intangible asset is considered impaired when its carrying amount exceeds its fair value, and the impairment loss recognized equals the amount of the excess. We perform our annual impairment test during the fourth quarter of each year. Trade names associated with our French disposal group are classified as assets held for sale in the consolidated balance sheet as of January 31st, 2026. The fair value of our trade names are estimated by using a relief from royalty approach, which assumes the value of the trade name is discounted cash flows and the amount that would be paid by a hypothetical market participant had they not owned the trade name and instead licensed the trade name from another company. Trade name has been reclassified and presented as assets held for sale in our consolidated balance sheet relating to our French disposal group as of January 31st, 2026. We recognize no impairment charges during fiscal 25, 24, and 23. See Note 10, Intangible Assets, for additional information. Our definite-lived intangible assets consist primarily of leasehold rights. The estimated useful life and amortization methodology of these assets are determined based on the period over which they are expected to contribute directly to cash flows. Intangible assets that are determined to have a definitive life are amortized over their respective useful lives. Leasehold rights associated with our French disposal group are classified as assets held for sale in the consolidated balance sheets as of January 31st, 2026. Revenue recognition. We recognize revenue when performance obligations are satisfied by transferring goods or services to the customer in an amount that we expect to collect in exchange for those goods or services. The satisfaction of the performative obligation with a single customer may occur at a point in time and may occur over time. The majority of our revenue is recognized at a point in time, generally when a customer purchases and takes possession of merchandise through our stores, or when merchandise purchased through our e-commerce platforms is delivered to a customer. Revenue is recognized net of sales discounts, sales returns, and estimated sales return reserves. Our sales return policy is generally limited to 15 days or less, and as such, our sales returns are, and historically have been, immaterial. Revenues do not include sales tax or other taxes collected from customers. We record a liability for taxes collected from a customer. Oh, interesting. We have arrangements with customers where our performance obligations are satisfied over time, which primarily relate to extended warranties in our GameStop Pro Reward program. In arrangements where we have multiple performance obligations, the transaction price is allocated to each performance obligation based on their relative standalone selling price. Subscription revenues for our GameStop Pro Rewards program membership are recognized on a straight-line basis over the subscription period. Revenues for extended warranties sold are recognized on a straight-line basis over the life of the warranty terms. Contract liabilities and other deferred revenues associated with gift cards, extended warranties, customer credits, and subscriptions to our GameStop Pro Rewards program memberships are included in accrued liabilities and other current liabilities on our consolidated balance sheets. We also sell a variety of digital products which generally allow consumers to download software or play games on the internet. Most of the digital products we sell are unbundled and do not require us to purchase inventory or take physical possession of or take title to inventory. When purchasing these products from us, consumers pay a retail price, and we earn a commission based on a percentage of the retail sale as negotiated with the digital product publisher. We recognize the sale of these digital products on a net basis, whereby the commissions earned are recorded as revenue. We also offer customers the ability to submit ungraded trading cards for third-party grading services. We act as an agent in these arrangements, and accordingly, revenue is recognized on a net basis, equal to the amount we retain after remitting pass-through charges. Amounts collected from customers prior to completion of the grading services are recorded as contract liabilities and are recognized as revenue once the grading is complete and the graded card is made available to the customer. Revenue recognized from grading services is categorized as collectible revenue. Damn, we need to revisit that. Rewards program. Our GameStop Pro rewards program allows paid members to earn points on purchases that can be redeemed for rewards that include discounts or coupons. Oh yeah. Oh yeah. Ruined it. So let's see. Amounts collected from customers prior to completion of grading are recorded as contract liabilities. Increase to contract liabilities, 664 million. Decrease to contract liabilities, 699 million. Huh, that's interesting. That's interesting. And I lost my spot again. No good. No good. We're... We read that. All right, so we're here. Temporarily gives up economic ownership of most Bitcoin in exchange for premium income, so it's not diluting shareholders, issuing debt. 0.78% in the notional value of the period options cover. Where are you getting this information from? If that's just like some AI shit, I wouldn't trust that. It's either a loan or it's yield. It's one of those two. I think it's a loan though, just based off of the website we read about pledged Bitcoin. I think it's just a loan. Okay. Reward program. Our GameStop Pro rewards program allows paid members to earn points on purchases that can be redeemed for rewards that include discounts or coupons. When rewards program members purchase our products, we allocate transaction price between the product and loyalty points earned based on the relative standalone selling prices and expected point redemption. The portion allocated to the loyalty points is initially recorded as deferred revenue and subsequently recognized as revenue upon redemption or expiration. The two primary estimates utilized to record the deferred revenue for loyalty points earned by members are the estimated retail price per point and estimated breakage. The estimated retail price per point is based on the actual historical retail prices of product purchased through the redemption of loyalty points. We estimate breakage of loyalty points based on historical redemption rates. We continually evaluate our methodology and assumptions based on developments in retail price per point redeemed, redemption patterns, and other factors. Changes in the retail price per point and redemption rates have the effect of either increasing or decreasing the deferred revenue liability through current period revenue by an amount estimated to represent the retail value of all points previously earned but not yet redeemed by loyalty program members as of the end of the reporting period. The cost of administering the loyalty program, including program administration fees, program communications, and cost of loyalty cards, is recognized in SG&A expenses on our consolidated statement of operations. Contract liabilities. We establish a liability upon the issuance of merchandise and credits the sale of gift cards and extended warranties. For merchandise, credits, and gift cards, revenue is recognized when customers redeem the related balances. We recognize breakage in revenue in proportion to historical redemption patterns as redemptions occur. If future redemption patterns differ from historical experience, the timing and the amount of breakage recognized may vary. For extended warranties, revenue is recognized over time on a straight-line basis over the warranty term. Vendor arrangements. We participate in vendor cooperative advertising programs and other vendor marketing programs in which vendors provide us with cash consideration in exchange for marketing and advertising the vendor's products. Our accounting for cooperative advertising arrangements and other vendor marketing programs results in a significant portion of the consideration received from our vendors, reducing the product cost in inventory rather than an offset to our marketing and advertising costs. The consideration serving as a reduction in inventory is recognized in cost of sales as inventory is sold. The amount of vendor allowances to be recorded as a reduction of inventory is determined based on the nature of the consideration received and the merchandise inventory to which the consideration relates. We apply a sell-through rate to determine the timing in which the consideration should be recognized in cost of sales. Consideration received that relates to gaming products that have not yet been released to the public is deferred as a reduction of inventory. The cooperative advertising programs and other vendor marketing programs, generally over a period from a few days up to a few weeks, and include items such as product catalog advertising, in-store display promotions, internet advertising, co-op print advertising, and other programs. The allowance for each event is negotiated with the vendor and requires specific performance by us to be earned. Vendor allowances of $70.7 million, $65.4 million, and $63.9 million were recorded as a reduction of cost of sales for fiscal 25, 24, and 23. Respectively, in our consolidated statements of operations, in certain instances, we receive cash considerations from vendors specifically to fund identifiable marketing and advertising activities, such as seasonal holiday guides and flyers. Accordingly, we present this as an offset to marketing and advertising expenses. Interesting. I didn't know they got like allowances for advertising. So technically GameStop doesn't really like spend any money on advertising because their vendors give them allowances to advertise for them. That's actually really interesting. Cost of sales and selling in general and administrative expenses classification. The classification of costs of sales and selling general and administrative expenses varies across the retail industry. We include certain purchasing, receiving, and distribution costs and selling general and administrative expenses in the consolidated statements of operations. We include processing fees associated with purchases made by credit cards and other payment methods in cost of sales in our consolidated statements of operations. Advertising expenses. We expense advertising costs for television, print, digital advertising, and other media when advertising takes place. Advertising expenses for fiscal 2025, 24, and 23 totaled $13.8 million, $18.6 million, and $39.3 million respectively. Wow, they're like barely paying. I mean, $13.8 million is quite a bit on advertising, but compared to GameStop like business as a whole, like that's nothing for advertising. And it's down a lot. Like 2023 was 39.3 million. Now they're barely spending like, 13 million or 14 million. Like that's crazy. That's a huge reduction in advertising cost. Income taxes. Income tax expense includes federal, state, and local and international income taxes. Income taxes are accounted for utilizing an asset and liability approach, and deferred tax assets and liabilities are recognized for the tax consequences of temporary differences between the financial reporting basis and the tax basis of existing assets and liabilities using enacted tax rates. Deferred tax assets and liabilities are measured using the enacted tax rates expected to apply to taxable income in the years in which those temporary differences are expected to be recovered or settled. The effect on deferred tax assets and liabilities of a change in tax rates is recognized in the period that includes the enactment date. Valuation allowances are recorded to reduce deferred tax assets to the amount that will more likely than not be realizable. In accordance with GAAP, we maintain liabilities for uncertain tax positions until examination of the tax year is completed by the applicable taxing authority, available review periods expire, or additional facts and circumstances cause us to change our assessment of the appropriate accrual amount. See Note 15, Income Taxes, for additional info. We do not assert indefinite reinvestment on the undistributed earnings of our foreign subsidiaries. Income tax and/or withholding tax associated with any amounts available for distribution as of January 31st, 2026 is not expected to be material to our financial statements. Leases. We conduct the substantial majority of our business with leased real estate properties, including retail stores, warehouse facilities, office space, and equipment. These are generally leased under non-cancelable agreements and include various renewal options for additional periods. These agreements generally provide for minimum and, in some cases, percentage rentals and require us to pay insurance, taxes, and other maintenance costs. Percentage rentals are based on sales performance in excess of specified minimums at various stores and are accounted for in the period in which the amount of the percentage rentals can be accurately estimated. All of our lease agreements are classified as operating leases. We determine if an arrangement is considered a lease at inception. We recognize right-of-use assets on the commencement date based on the present value of future minimum lease payments over the lease term, including reasonably certain renewal options. As the rate implicit in the lease is not readily determinable for most leases, we utilize our incremental borrowing rate, IBR, to determine the present value of future payments. The incremental borrowing rate represents a significant judgment that is based on an analysis of our credit rating, country risk, corporate bond yields, and the effect of collateralization. For our real estate leases, we do not separate the components of a contract, thus our future payments include minimum rent payments and fixed executory costs. For our non-real estate leases, future payments include only fixed minimum rent payments. We record the amortization of our ROU assets and the accretion of our lease liabilities as a single lease cost on a straight-line basis over the lease term, which includes option terms are reasonably certain to exercise. We recognize our cash or lease incentive as a reduction to the ROU asset. We assess ROU assets for impairment in accordance with our long-lived asset impairment policy, which is performed periodically, or when events or changes in circumstances indicate that the carrying amount may not be recoverable. All right, later, Moose. Have a good one, bro. Foreign currency. Generally, we have determined that the functional currencies of our foreign subsidiaries are the subsidiaries' local currencies. The assets and liabilities of the subsidiaries are translated into US dollars at the applicable exchange rate as of the end of the balance sheet date, and revenue expenses are translated into US dollars at an average rate over the period. Currency translation adjustments are recorded as a component of other comprehensive income in our consolidated statement of comprehensive loss. Currency translation adjustments related to divested foreign businesses are reclassified into earnings as a component of selling, general, and administrative expenses in our consolidated statement of operations once the liquidation of the respective foreign business is substantially complete. Gains and losses arising from transactional denominated in non-functional currencies resulted in a net gain of $1.1 million and net loss of $0.9 million and $2 million for fiscal 25, 24, and 23. Interesting. They actually had a gain on that. These costs were recognized in selling, general, and administrative expenses in our consolidated statement of operations. We have historically used forward exchange contracts to manage currency risk, primarily related to foreign currency denominated intercompany assets and liabilities. The forward exchange contracts are not designated as hedges, and therefore, changes in the fair value of these derivatives are recognized in earnings, thereby offsetting the current earnings effect of the remeasurement of related intercompany loans. See Note 11, Fair Value Measurements, for additional information regarding our forward exchange contracts. New accounting pronouncements. Recently adopted accounting pronouncements. In December 2023, the Financial Accounting Standards Board, FASB, issued SAU number 2023-08, Intangibles, Goodwill, and Other Crypto Assets, subtopic 350-60, Accounting for and Disclosure of Crypto Assets, ASU 2023-08. ASU 2023-08 requires certain crypto assets, such as Bitcoin, to be measured at fair value at each reporting date, with changes in fair value recognized in earnings, and to be presented separately from other intangible assets, together with enhanced disclosure, including the name, number of units, cost basis, and fair value for each significant crypto asset holding. The standard is effective for fiscal years beginning after December 15th, 2024, including interim periods therein. Early adoption is permitted. We adopted ASU 2023-08 on a modified retrospective basis, effective February 2nd, 2025. The company did not hold material crypto assets immediately prior to adoption. Accordingly, the cumulative effect adjustment to opening retained earnings and the impact of our consolidated balance sheet were immaterial. In December 2023, the FASB issued ASU number 2023-09, Income Taxes, Topic 740, Improvements to Income Tax Disclosures. This standard enhances disclosures related to income taxes, including the rate reconciliation and information on income taxes paid. This ASU is effective for annual periods beginning after December 15th, 2024. The company adopted ASU 2023-09 during fiscal 2025 and elected to apply the standard on a prospective basis. See Note 15, quote, Income Tax, to our consolidated financial statement included in this annual report on Form 10-K for additional information. Recently issued accounting pronouncements. In November 2024, the FASB issued ASU 2024-03, Income Statement, Reporting Comprehensive Income, Expense Disaggregation Disclosure, Subtopic 220-40, Disaggregation of Income Statement Expenses, as clarified by ASU number 2025-01, Income Statement - Reporting Comprehensive Income - Expensive Disaggregation Disclosures, Subtopic 220-40, clarifying the effective date, collectively ASU 2024-03. This guidance includes amendments to require public companies to provide additional disaggregated information about certain costs and expenses in a tabular format. The ASU is effective for annual periods beginning after December 15th, 2026, and interim periods beginning after December 15th, 2027. Early adoption is permitted. The company is currently evaluating the impact that the adoption of this standard will have on the company's consolidated financial statements. Oh, interesting. So that's going to be something new. Revenue. Oh, nothing here. I'll just take a break for a sec. Take a break for a gosh darn second. Where is this? How much longer, bro? How much longer? Are we almost done? Fuck me, man. There's still so much to read. Fuck. Fuck. I was hoping we'd be done soon. But there's still so much. There's still so much. And I lost my spot, so that's not good. Where were we at? I lost my spot. No. Oh, wait, right here. Okay, cool. Okay, cool. I got the will of an Iron Man. I just want to read all this stuff. I have a lot of money in this stock, and I'm interested in the business. And you know, it's the only business I actually like pay attention to and care about. So like diving into all this information, though it's probably useless in reality, like it's good to know. I need to try to finish this though. Might go play some Magic here in a little bit. So let's get this shit fucking done, bro. Let's get this shit finished. All right, revenue. This is just you know, we've already gone through the revenue, I feel like. Performance obligations. We have arrangements with customers where our performance obligations are satisfied over time, which primarily relate to extended warranties in our GameStop Pro Rewards program, formerly known as Power Up Rewards. We expect to recognize revenue in future periods for remaining performance obligations we have associated with unredeemed gift cards and trading credits, reservation deposits, and loyalty points earned as part of our GameStop Pro Rewards program, collectively unredeemed customer liabilities, extended warranties, and subscription to our GameStop Pro Rewards program. Also, like, reading this, you actually get to see what exactly is where in the numbers. Like, if you were just looking at the balance sheet and you saw unredeemed customer liabilities, you probably wouldn't know what that was unless you read this, or you've already read it before. So it's like you're also putting more information onto the simple version of the balance sheet and like the financial statements, I guess, if that makes sense. So in a lot of ways, it is worth reading all this information because you're just getting a better idea of how they report like the simple information, because it's not so simple when you actually look into it. A lot of people just look at numbers on a screen and it's a number. Like they don't actually know what they're looking at. All right, performance obligations associated with unredeemed customer liabilities are primarily satisfied at the time customers redeem gift cards, trading credits, customer deposits, or loyalty program points for products that we offer. Unredeemed customer liabilities are generally redeemed within 1 year of issuance. We offer extended warranties on certain new and pre-owned products with terms generally ranging from 12 to 24 months. Depending on the product, revenues for extended warranties sold are recognized on a straight-line basis over the life of the contract. Revenues for subscriptions to our GameStop Pro Rewards program are recognized on a straight-line basis over a 12-month subscription term. Following table represents performance obligations recognized in accrued liabilities and other current liabilities on a consolidated balance sheet. So unredeemed customer liabilities, 106 million, extended warranties, 45 million, and subscriptions, 43 million. All down from 2024. I don't know if subscriptions being down is a positive thing, but the other two are potentially pretty positive. Significant judgments and estimates. We accrue loyalty points related to our GameStop Pro Rewards program at the estimated retail price per point, net of estimated breakage, which can be redeemed by loyalty program members for products we offer. The estimated retail price per point is based on the actual historical retail prices of products purchased through the redemption of loyalty points. We estimate breakage of loyalty points and unredeemed gift cards based on historical redemption rates. Contract balances. Our contract liabilities primarily consist of unredeemed customer liabilities and deferred revenues associated with gift cards, extended warranties, and subscriptions to our GameStop Pro Rewards program. And you can see increase to contract liabilities, 664 million, decrease to contract liabilities, 699.8 million, other adjustments, and then contract liability ending balance, 194 million, compared with 2024 was 228 million. And this also includes the PSA graded cards that haven't been returned to customers as well, as we read at the top. Includes issuances of gift cards, trading credits, and loyalty points, new reservation deposits, new subscriptions to our GameStop Pro Rewards program, and extended warranties sold. 2 consist of redemptions and breakage of gift cards and trading credits, redemptions and breakage of reservation deposits, and expirations of loyalty points. Additionally, this includes revenues recognized for our GameStop Pro Rewards program and extended warranties. During fiscal 2025, there were 42.7 million of gift cards redeemed that were previously outstanding as of February 1st, 2025. During fiscal 2024, there were 44.5 million of gift cards redeemed that were previously outstanding as of February 3rd, 2024. Wow, they get a lot of gift card redemptions. And 3 primarily includes foreign currency translation adjustments, which I guess is other adjustments. Okay. Segment information. Again, here we go, reading this for the 4th time. Effective May 4th, 2025, we operate our business in 3 geographic segments, United States, Australia, and Europe. During the second quarter of fiscal 2025, we divested our operations in Canada, which previously comprised a 4th separate reporting segment. We identified segments based on a combination of geographic areas and management responsibilities. Segment results for the United States include retail operations in 50 states, our e-commerce website, www.gamestop.com, and our GameStop Pro loyalty program. The United States segment also includes general and administrative expenses related to our corporate offices in Grapevine, Texas. Segment results for Canada include retail and e-commerce operations we previously had in Canada. Segment results for Australia include retail and e-commerce operations in Australia and New Zealand. During the 4th quarter of fiscal 2025, we closed down our store operations in New Zealand. Current year segment results for Europe include retail and e-commerce operations in France. Our segment results for Europe also previously included retail operations in Italy, Germany, Austria, Ireland, and Switzerland. Current year segment results for Europe include retail and e-commerce operations in France. Our segment results for Europe also previously... so maybe France is the reason why Europe's losing so much money. So Europe could be potentially profitable now. Maybe France is the reason why they're losing so much money. I mean, we'll find out, but that's see, this is the thing, bro. You go through all this 5-6 hours of reading, and there's just like little things that you would never know unless you read the whole thing. Nobody knows this, Nobody knows this. Our chief operating decision makers, CODM, are our chief executive officer and our principal financial accounting officer, who have responsibility for allocating resources and assessing performance for the operating segments. Our CODM measures segment profit using operating income loss, which is defined as net income loss from operations before interest income, net, income tax expense, benefit, and loss gain on digital assets and related receivables. Transactions between our reportable segments consist primarily of royalties, management fees, inter-segment loans, and related interest. There were no material inter-segment sales during fiscal 2025, 24, and 23. Information on total assets by segment is not disclosed, as such information is not used by our CODM to evaluate segment performance or to allocate resources and capital. And yeah, I always like this part of the balance sheet because it tells you exactly, United States, they made 283 million income. Canada lost 22 million. Australia made 4.6 million. And Europe lost 33.5 million. But Canada's now gone. And maybe Europe will be less, maybe they'll be losing less, or maybe they'll be profitable now with the exit of France. You never know. Because Australia, I believe, wasn't profitable. I can't remember exactly, but I don't think Australia was profitable until they got rid of New Zealand. Yeah, and they give you quite a bit of information on the individual segments, geographical segments. Like for the quarter, the U.S. made 34 million, Canada lost 10 million, Australia lost 12 million. I think this is for the quarter, right? Oh no, that's for the year. Wait. Oh, this is last year. Okay, so this is for 2025. This is for 2024. Gotcha. So yeah, Australia wasn't profitable last year, but now they made 4 million. And yeah, it's good to know. I like that they have this in here. Associates defined contribution plan. We sponsor a defined contribution plan, the quote savings plan, for the benefit of substantially all our U.S. associates who meet certain eligibility requirements, primarily age and length of service. The savings plan allows associates to invest up to 60%, subject to IRS limitations, of their eligible gross cash compensation on a pre-tax basis. Historically, the company provided matching contributions to the saving plan based upon a certain percentage of the associate's contribution. Our contributions to the saving plan during fiscal 25, 24, and 23 were nothing, and 3.6 million, respectively. Effective January 1st, 2024, the company eliminated employer matching contributions for employees. Oh, interesting. See, I didn't know that. That's good to know. Even though that was probably in last year's earnings statement, I don't remember reading about that. Earnings per share. Basic net income per common share is computed by dividing the net income available to Class A common stockholders by the weighted average number of common shares outstanding during the period. Diluted net income per common share is computed by dividing the net income available to Class A common stockholders by the weighted average number of common shares outstanding and potentially dilutive securities outstanding during the period. Potentially dilutive securities include shares from convertible notes, stock options, warrants, unvested restricted stock, and unvested restricted stock units outstanding during the period. Using the treasury stock method, potentially dilutive securities are excluded from the computations of diluted earnings per share if their effect would be anti-dilutive. For example, the warrants are anti-dilutive and are excluded from the diluted earnings per share computations, primarily because the exercise price is significantly above the average market price. Whoa! The warrants are whoa! So the bonds are technically anti-dilutive as well. No way! I think. No way! So all the people complaining about dilution, that's not even reality. Oh, bro, this is fucking great, man. This is great. A net loss from continuing operations causes all potentially dilutive securities to be anti-dilutive. A net loss from continuing operations causes all... Oh, okay. That's awesome, bro. I love this. I love this. I won't go through those. We gotta get this finished, bro. There's Still quite a bit more. Our total depreciation expense was $19.4 million, $38.4 million, and $55.3 million for fiscal 25, 24, and 23, respectively, and is recorded in selling, general, and administrative. I can't read. All right, well, we gotta stop. I can't read, bro. I can't read. I can't read. I don't know how to read. Boy, I can't read. I don't know how to read, man. I don't know how to read. Boy. Only Roy and Corey chat getting the scoops. Yeah, facts. Ain't nobody else reading this, I'm sure. I mean, maybe there's someone out there, like Michael Burry or something, but ain't nobody else reading this, bro. Give it up, Corey. There's always tomorrow. I think you're at the point where it won't sink in. I mean, I can always just watch the video back. I recorded all of this, so. And I'm sure I'll, over the next 3-4 months, I'm sure I'm going to come back and read stuff in here. I ain't giving it up, bro. We're almost done. It's so close. We're so close. Okay, we're not that close. We're not that close. Kill me. Kill me. Just do it. Just end me now. Just kill me now. Fuck. No. No. Part 3? No. I mean, how long is this gonna take, bro? I really want to go play Magic. It's mixed up. I want to go play Magic, but I also want to finish this. We're just so close to being done, man. We're just so close. I just don't know how much longer it's going to take. It's either going to be like 30 minutes or an hour. And if it's an hour, that sucks. God, we're so close, though. We're like right there, man. You ain't got... Bro. Don't you threaten me with a good time. I'm gonna fucking finish it, bro. I'm gonna finish it. I hate you guys. Telling me I can't finish. I will. Watch. Just you watch. Property and equipment. Property and equipment reclassified as held for sale that related to our French disposable group are excluded from the table above and presented with property and equipment net within assets held for sale in our consolidated balance sheet as of January 31st, 2026. I don't really want to go through that, but anyway, our total depreciation expense was $19.4 million, $38.4 million, and $55.3 million for fiscal 2025, 24, and 23, respectively, and is recorded in selling, general, and administrative expenses in our consolidated statements of operations. In fiscal 2024, we closed our distribution facility in York, Pennsylvania, and consolidated U.S. fulfillment activities into our facility in Grapevine, Texas. During the same period, we relocated our U.S. refurbishment operations into our Grapevine, Texas distribution and administration facility. Previously, refurbishment operations were conducted in a separate facility also located in Grapevine. We also divested our operations in Italy, which included our facility in Milan. In fiscal 2025, we divested our operations in Canada, including our distribution and administration facility in Brampton, Ontario. During the same period, management approved a plan to divest our operations in France, and all related property and equipment were reclassified as held for sale. Leases. Operating lease costs, $197 million. Wow, their operating lease cost is down quite a bit. Variable lease costs also down. So total rent expenses is down quite a lot, almost a third. Wow. Variable lease costs include percentage rentals and variable executionary cost. In fiscal 2025, we recognized $0.9 million of store-level ROU asset impairment charges, compared to $0.7 million and $2.7 million of store-level ROU asset impairment charges in fiscal 24 and 23. Following table presents the weighted average remaining lease terms, which includes reasonably certain renewal options, and the weighted average discount rate for operating leases included in the measurement of our lease liability. Weighted average remaining lease terms years, 3.4. Weighted average discount rate, 6.3%. Interesting. Weighted average remaining lease terms is weighted based on the lease liability balance for each lease as of January 31st, 2026 and February 1st, 2025. The weighted average discount rate weights the IBR determined for each lease based on each lease's respective liability balance as of January 31st, 2026 and February 1st, 2025. Following table presents expected lease payments associated with our operating lease liabilities, excluding percentage rentals for the next 5 fiscal years. Oh, this is pretty cool. So 2026, $104 million, right? I think. Then 27, $70 million. I don't know if that's accurate or not. Expected lease payments associated with our operating lease I guess that's accurate. Wow. So in 2030, they're basically not going to have any lease payments. If I'm reading that correctly, like that's insane. That's actually insane. Maybe they plan on closing all the stores or something, or like a huge majority of the stores. That's weird. That's weird. That's very weird. I'm confused by that. 1. Operating lease payments exclude legally binding lease payments for leases signed but not yet commenced. Oh, okay. So it's excluding a lot of stuff. So they don't know exactly. This is just what it is now, because they'll probably sign new leases after 26 and 27. Okay. I see. 2. The future lease payments presented in the table above include amounts related to operating leases associated with our French disposal group, classified as held for sale. The related lease liabilities, totaling approximately $43.5 million, have been reclassified to liabilities held for sale on the consolidated balance sheet and are not included in the lease liabilities line item as of January 31st, 2026. With this reclassification, the present value of the lease payments reconciled to the total lease liabilities recognized. The present value of lease liabilities consists of $87.5 million, classified as current portion of operating lease liabilities, and $110.1 million, classified as long-term operating lease liabilities, on our consolidated balance sheet. Intangible assets. Following table represents the gross carrying amount and accumulated amortization of our intangible assets. They have none? Oh yeah, I think we already read about that. They literally have none. They had That's weird. Let's see. Trade name. 1. Trade name and leasehold rights. Key money reclassified as held for sale that relate to our French disposal group are excluded from the table above and presented within other non-current assets within assets held for sale in our consolidated balance sheet as of January 31st, 2026. 2. Other intangible assets relating to a portfolio of product designs that were created by GeekNet as part of an acquisition that has been fully amortized are no longer utilized by the company and have been removed from the company's books in the table above as of January 31st, 2026. Is that interesting? So they got rid of like 87 million of intangible assets or something? I guess. Interesting. Indefinite-lived intangible assets, trade name. Our trade name relates to Micromania SAS, Micromania, our retail operations business in France, which we acquired in 2008. There were no impairment charges recognized during fiscal 2025, 24, and 23 related to the trade name. The trade name has been reclassified and presented as liabilities held for sale in our consolidated balance sheets and excluded from the table above as of January 31st, 2026. Finite-lived intangible assets. Leasehold rights, the majority of which were recorded as a result of the purchase of Micromania in 2008, represent the value of rights of tenancy under commercial property leases for properties located in France. Rights pertaining to individual leases can be sold by us to a new tenant or recovered by us from the landlord if the exercise of the atomic right of renewal is refused. Leasehold rights are amortized on a straight-line basis over the expected lease term, not to exceed 20 years, with no residual value. Leasehold rights have been reclassified and presented as assets held for sale in our consolidated balance sheets and excluded from the table above as of January 31st, 2026. As of January 31st, 2026, the total weighted average amortization period for our finite-lived intangible assets was approximately 7 years. The intangible assets are being amortized based upon the pattern in which the economic benefit of the intangible assets are being utilized, with no expected residual value. Intangible assets amortization expense during fiscal 25, 24, and 23 was $0.1 million, $0.5 million, and $0.9 million respectively. Fair value measurements. Fair value is defined as the price that would be received from selling an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Applicable accounting standards require disclosures that categorize assets and liabilities measured at fair value into one of 3 different levels depending on the observability of the inputs employed in the measurement. Each fair value measurement is reported in one of the following 3 levels. Level 1, inputs are quoted prices in active markets for identical assets or liabilities. Level 2, inputs are observable inputs other than quoted prices, including in level 1, for the asset or liability, either directly or indirectly through market corroborated inputs. Level 3, inputs are unobservable inputs for the asset or liability, reflecting our assumption about pricing by market participants. What's up, Joe DeBango? There's been some interesting stuff. Assets and liabilities that are measured at fair value on a recurring basis. Assets and liabilities that are measured at fair value on a recurring basis include our cash equivalents, marketable securities, digital assets receivable, foreign currency contracts, derivative assets and liabilities, company-owned life insurance policies with a cash surrender value, and certain non-qualified deferred compensation liabilities. We measure the fair value of cash equivalents, certain marketable securities, and digital assets based on quoted prices in active markets for identical assets. Other marketable securities were valued either based on recent trades of securities in active markets or based on quoted market prices of similar instruments and other significant inputs derived from a corroborated by observable market data. Our investments in time deposits are reported at fair value and utilize level 1 inputs for measurement. We measure the fair value of our foreign currency contracts, derivative assets and liabilities, digital assets receivable, life insurance policies with cash surrender values, and certain non-qualified deferred compensation liabilities based on level 2 inputs, using quotations provided by major market news services, such as Bloomberg, and industry standard models that consider various assumptions, including quoted forward prices, time value, volatility factors, contractual prices for the underlying instrument, and other relevant economic measures, all of which are observable in active markets. When appropriate, valuations are adjusted to reflect credit considerations, generally based on available market evidence.